I don't think the Fed is, at this point, in any need, nor are they being compelled to move rates in either direction.
The hawkish case for the near term is do nothing, and the dovish case is anything different than that.
We could get too much easing before inflation makes its way down to more stable zone.
Perhaps they will find an opportunity to initiate a rate cut this year, just depending on how the data, particularly the inflation prints, play out.
There's a little bit of downside risk to this market, and I think that's underappreciated.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance with equity futures negative by 0.6% on the S&P 500. Decent close in the equity market yesterday. Can't say the same thing about the bond market. Some shaky stuff. 3 points to make here. Hawkish Fed speak on repeat. We'll talk about Kashkari a little bit later. Consumer confidence a little bit better than expected. That bounces. And as I said just yesterday, the most important thing that would take place was bond issuance. I didn't say that. Bramo did. Here's your day ahead. The next 24 hours looks like this. More bond issuance for you. We will have $44 billion of 7-year notes coming to market. The beige book will be released. And we'll hear from New York Fed President John Williams for the first time a little bit later on this morning. And then you will hear from him again tomorrow.
Which to me comes interestingly after we heard from Neil Kashkari, not necessarily taking rate hikes off the table. We've heard this before from him, and he is more hawkish on the margins. But is the reaction function changing on the margins, given the fact that confidence is coming in stronger than expected? And auctions are absolutely the most important thing for a week where otherwise there is a vacuum of other types of data points.
To be fair on the auctions, though, it was after Memorial Day weekend. So potentially people are still at the beach. They're taking it easy as they come back in and they ease into the week. When it comes to Kashkari, not so much that hikes are still on the table. What I thought was interesting is this, but I can tell you this, it certainly won't be more than 2 cuts. Remember we were talking about 6 or 7? He's saying definitely not that, certainly not more than 2. I'm more interested in Williams tomorrow because the venue, maybe it's a place where he would want to shift tone or change of tweaking of policy.
Are you raining on Lisa's parade? Because we should spend some time talking about the bond supply. So we had 2 auctions yesterday at the front end. What was it, 2-year, 5-year?
Yep.
Both were a little bit softer than expected. I think that move reinforced by that bounce back in consumer confidence, and the backdrop was the hawkish Fed speak, but ultimately a little bit softer than expected.
What that means is, number one, the bond traded at a lower price, higher yield after it was issued, and also dealers were stuck taking down more of the notes. In other words, other kind of investors weren't as strongly bidding as the actual dealers were, which is usually a sign of weaker demand. Granted, it is true. A lot of people are on the beach. On the other hand, you would think that if you've got yields close to 5%, suddenly people would think, okay, this is a good time to buy. I mean, we're just kicking back up to that higher for longer being 5% on the short end of the yield curve, and people aren't biting. That is indicative of a lot of feelings and a lot of fear of potentially what a new higher for longer means.
Getting closer to 460 on a 10-year this morning at 456.98. That's the bond market. Lots more still to come about that. I want to talk about a single name in the pre-market. American Airlines getting hammered in early trading. We're down here by close to 8%. They've come out and cut the outlook. Adjusted earnings will be $1 to $1.15 a share in the second quarter. That's down from a previous expectation of only a few weeks ago of as much as $1.45. That is a big adjustment, Lisa, to the outlook.
And this has to do with higher costs, and it also has to do with fears that maybe American isn't doing as much to really bring in the revenues. Their also chief revenue officer essentially stepped down. So there are questions about what their plan was with that. There also are questions about whether maybe they're catering more to a domestic flyer base and ones that are more budget conscious, which puts them on a different plane in terms of the competitive advantage or lack therein compared with, say, Delta.
Jefferies now says they have a stock as a whole, no longer a buy. They said the strategy has not gone to plan that they were expecting. And this was the quote I loved. It's not all sunshine and rainbows for American Airlines, and it's certainly not this morning.
Is there an airlines problem or an American Airlines problem? And the reaction you get from the South Side overnight sounds much more like an American Airlines problem than an airlines problem.
That's what the reaction sounded like, and yet somehow that dragged down the shares of Delta and United. So go figure. Maybe if this is just an American airline issue, maybe it's a buying opportunity for Delta and United, but right now people aren't really maybe buying
We'll see if we get the adjustments from those companies this morning and through the next couple of days. Equity futures right now on the S&P, the scores look like this. We are lower by 0.6% on the S&P 500. Life could be easy. You could just own Nvidia. 3 days, we've had a move of 20%. Over those 3 days, Bramo, the market cap move, $466 billion US dollars market cap added to this company.
That's insane. That's more than 2 McDonald's added to this, added to the market cap of this company in just 3 trading sessions. Again, you've pointed this out before. It is remarkable with that kind of move in a $2 trillion stock, more than that, $2.5 trillion stock. Now it's probably almost $3 trillion. It's amazing to see that and not see the entire market rally. It just shows that the gravitational force of higher yields and the threat of maybe higher for longer is pulling down everything else, even with the secular story of artificial intelligence.
2.8 trillion now. It's bonkers, isn't it? Coming up this hour, here's the lineup for you. James Athey of Marlborough Investment Management as the Fed's Kashkari keeps a hike on the table. Former White House fellow Elliot Ackerman on Israel's advance in Gaza, and we'll catch up with Amanda Lynam of BlackRock on the growing divide between US consumers. We'll begin with our top story. Higher bond yields happen to push futures lower following comments from Kashkari and a pair of weaker than expected debt auctions. Fed President Kashkari saying this: I don't think anybody has totally taken rate increases off the table. I think the odds of us raising rates are quite low, but I don't want to take anything off the table. James Athey of Marlborough joins us now for more. James, first of all, what did you make of that Fed speak? Is it anything new at all? For me, at least, it didn't feel like it was. So what would explain that weakness that we saw in those bond issues yesterday?
Hey, John, good to see you again. I don't think we've learned anything hugely new here. I think certainly the latest FOMC minutes really did suggest that there are quite a few participants who are getting a little uncomfortable with the whole financial conditions situation. And I think that's, reasonable that they do so, because the sort of direct link, if you like, between their policy setting and their communication and asset prices has to some degree been pretty weak recently. And you guys have just been noting that the tear that certain mega cap stocks have been on, and obviously that does in and of itself, provide some loosening of financial conditions. And really, that's not what the Fed wants to see. Ultimately, as Mr. Kashkari has said, I think the chances of hikes are still fairly low. I think the Fed would prefer to keep policy, in a tight setting for a longer period of time, as opposed to try and tighten things, because they could very quickly and easily lose control of the narrative and of financial conditions if they restarted hikes now.
James, they're low, but they're not zero. This is what Peter Cheer of Academy had to say. People are consigned to the view that if we get a hike, it will only be because the economy remains incredibly strong, so it won't be a big deal. James, when I read that yesterday in the research of Academy, I have to tell you, I took a step back and thought, really? Is that really the impression of clients of Peter Cheer? James, is that your impression of things? How well would we take that?
I mean, from an economy perspective, it's not a big deal. I think for 30 years, we've really overestimated the significance of minor monetary policy changes on economic activity. And the lesson that we possibly should have learned over these last 12, 18 months is that, monetary policy is not really the deciding factor for economic decision making 99 times out of 100. There are myriad other factors that drive the economy forwards or backwards, and monetary policy can influence that at the margin and over much longer time horizons. I think I'd have concern that it would cause a few ructions from a market perspective. Again, equities are pretty significantly over their skis in valuation terms, particularly in the US. It's a hugely consensus trade. And what happens is, even if there is only one hike potentially on the table, you have to start considering the right tail opening up, i.e. what if? What if it's not just one hike? What if it's two? And you know how the market works. As we saw at the end of last year, you quickly go from, they might cut 1 or 2 times to they might cut 6 or 7. Potentially, if the data were hot for a few months, we could really start to price a considerable restarting of hiking. And I don't think equities would like that at all.
James, I want to dig into what you were talking about, essentially that if there were another rate hike, it wouldn't materially change the economic outlook. And yet, even with that massive move in NVIDIA, as John was talking about, we've still seen the market kind of go nowhere. If anything, kind of go south. As the market was priced in, only one rate cut now by year end, priced out a lot of the other potential easing that they had seen previously. Are you basically saying the reason why stocks are so sensitive to any kind of iteration of Fed policy is simply because people are looking for an excuse to sell incredibly inflated valuations right now in stocks?
I'm not sure that's true, Lisa. I kind of wish it were true, because it would suggest there were more sort of fundamental investors out there. I fear there are more technical than fundamental investors driving the equity market on a daily basis. And that's why I say, if the Fed credibly made a commitment that it was going to do one hike and no more, and the market believed that, I don't think it would be hugely disruptive at all. I think even the equity market could take it in its stride. you know the way equities work, right? There's sort of two sides to the coin, and they both work in equities' favor. Either growth is good, so you buy equities because earnings are going up, or growth is not good, but the Fed's going to ease, and that's going to support equity valuations. Either way, you stay long equities, you go long equities, you buy equities. That's the way the story works right up until unemployment starts shooting materially higher, and we have to face a recession really close up. So if it were just one hike, that's going to have not really any economic impact, and it would be almost a sign of strength. It would be confirmation that the US economy is strong, and I think equities would enjoy that. I think it just, if equities had to consider potentially a more significant additional tightening of policy, it would have to raise the prospects for a much more rapid, a much more significant growth slowing. And of course, it should impact equity valuations via the whole discounting of future cash flows argument. So for me, one and done, that wouldn't be a problem. If the market weren't convinced of that and had to consider 2, 3 or 4 hikes, I think that would be disruptive. Again, that's not what I'm expecting.
James, it sounds like you're a little bit frustrated by this stock market rally. Is that true? You're talking about how everything is positive and, it seems like it can never go down until it faces some sort of recessionary pressure. Is that sort of the place you're in?
I feel like I should be lying on a couch as we have this conversation, Lisa. But yeah, I mean, frustrated.
Bond market therapist.
Exactly. Frustrated. Yeah, I think it concerns me. I guess it is slight frustration because I come on TV and say equities are expensive, and then they just go on a tear and I look a fool. But no, seriously, it's more about the fact that I have concerns. I have concerns about the fragilities. I have concerns that investors and economic actors are sort of learning the wrong lesson. And we know from history that when this happens, you do build up into these, call them Minsky moments, call them dislocations. You build up these risks to the system that come from sort of throwing away some pretty fundamental principles of investing. And ultimately, price is what you pay, value is what you get over long periods of time. The valuation that you have paid for a given asset is the number one predictor for the long-term returns from that asset. And when you have such significant concentration as we do, and such significant participation in the equity market, not just from US domestic retail investors, but globally, that raises the prospect that if that turns around, it can become a really disruptive force in the other direction.
So, James, what are you advocating for in fixed income? What are you doing?
Yeah, I mean, I think there is, again, uncertainty is often used as an excuse not to act. And sure, there is uncertainty over the growth and inflation outlook. I would openly question whether there have ever been periods of certainty. And if there were, is it not the case that that certainty is fully reflected in asset prices, and therefore investing on that premise is not going to yield excess returns? So I think the bond market is to a significant degree currently compensating you for that uncertainty in a way that potentially the equity market is not. And so, as always, we would advise diversification both across asset classes and across geographies is wise. But yeah, we think duration is already attractive, and we're quite happy to lean into some of the bond market weakness that we have seen in the last few days, and that potentially we will see as we wrestle with this idea of whether Fed policy is actually tight or not.
Mr. Athey, it's been too long. It's good to see you, buddy, as always.
Too long, John. Good
Thank
to
you,
see
sir. James Athey of Marlborough, sounding like a frustrated bond manager throwing shade at equity investors. They've got an easy life. Stocks just go up until they don't.
Well, it's true. I mean, we were talking about bad news is good news and good news is good news. It's all good news for stocks until it's not, until you look into the face of some sort of recessionary increase in unemployment, and then it's all over. But, the idea that he's saying there's a lot of uncertainty, he can argue whether there's ever certainty, but bonds seem to compensate you more.
Buy bonds and stay diversified. That's the pitch. Equity futures right now in the S&P negative by 0.6%. Let's get you an update on stories elsewhere. Here's your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Jurors are expected to begin deliberations today in Donald Trump's hush money trial. After more than 6 weeks of testimony, closing arguments wrapped up last night. The prosecutor urged the jury to consider what he called a mountain of evidence that showed Trump tried to influence the 2016 election by paying a porn star to stay silent about an alleged affair. Trump's defense attorney said prosecutors failed to prove the records were false or that the former president intended to influence the election. ConocoPhillips is in advanced talks to acquire its smaller rival, Marathon Oil. The FT reported the proposed all-stock deal would value Marathon at more than $15 billion. It would give Conoco control of assets in Texas, Oklahoma, North Dakota, and the Permian Basin. In other commodity deal news, Anglo American has rejected BHP's request for a deadline extension in its takeover talks. BHP had asked its smaller rival for more time to negotiate a $75 billion takeover. Anglo, for its part, opposed the complicated deal structure and said its biggest concerns have still not been addressed. Now BHP must wait 6 months before it can make another offer. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes' time. This came from you, Mitch. Adam Simon, Professor of Earth and Environmental Studies. Take a listen to this. A normal Honda Accord needs about 40 pounds of copper. The same battery electric Honda Accord needs almost 200 pounds of copper. Onshore wind turbines require about 10 tons of copper, and in offshore wind turbines, that amount can more than double. The conclusion of the paper: the amount of copper needed is essentially impossible for mining companies to produce. This is a big factor in that story between BHP and Anglo.
Basically, the reason why Anglo is saying $49 billion doesn't come close to the valuation that they should potentially get. Whether BHP is going to offer them more, they have until 5 p.m. London time.
Insatiable demand for copper. And this is why Jeff Curry says it is the best trade he's seen in his lifetime.
The trade of a lifetime. More on that a little bit later. Up next on the program, the White House holding the line.
I have no policy changes to speak to. It just happened. The Israelis are going to investigate it. We're going to be taking great interest in what they find in that investigation.
That conversation coming up next, live from New York City this morning. Good morning. Live from New York City, equity futures negative by 0.6% on the S&P 500. Decent close to the session yesterday. Decent. Not in the bond market, though. Yields up again by a basis point or two. On a 10-year, 456.59. More on that a little bit later. Under surveillance this morning, the White House holding the line.
I have no policy changes to speak to. It just happened. The Israelis are going to investigate it. We're going to be taking great interest in what they find in that investigation. It's not in Israel's best interest, and it's not in our best interest for Israel to become increasingly isolated on the world stage.
So here's the latest. The White House saying a deadly Israeli airstrike in Rafah won't stop President Biden from sending arms shipments to the country. This comes as international condemnation against Israel continues to grow. Former White House fellow Elliot Ackerman saying this: Israel is struggling to communicate its vision of not only its wartime objectives and strategy, but also what Gaza would look like post-war. This makes the cost of such strikes much more costly politically. Civilian casualties play right into the hands of Hamas. Elliot Ackerman joins us now for more. Elliot, great to catch up with you, sir. If we can just play what if, just to start this conversation, what would this conflict look like without US support?
Well, it makes the margins for prosecuting the conflict much more tight for the Israelis, and it also would further isolate them, but also further make it more difficult for the U.S. to influence conditions on the ground. So, to me, it seemed that the Biden administration is appropriate in continuing to support Israel, despite the fact that we've had another instance of civilian casualties.
Elliot, what do you view as the president's red line when it comes to Israel?
I'm not completely sure that there is some hidden red line here. And I think if there's one thing President Biden probably has learned from his time serving in the Obama administration is that actively telegraphing red lines isn't strategically wise. But I'm sure there is a lot of frustration behind the scenes, and sometimes that frustration spills out into the public view about not only Israel's prosecution of the war when there are civilian casualties, but up to this point, sort of Israel's inability to clearly articulate on the world stage sort of what the end state is. Where is this all leading, so that the Biden administration and the world can kind of see the off-ramp here?
Yesterday, the AFP reported that Israeli forces have reached the center of Gaza. Is it your understanding that this is the start, then, of a major ground invasion?
It most certainly is. And, we've seen multiple incursions into Gaza by Israeli forces. But what we're sort of not seeing is a clear vision for how those incursions lead to a cessation of the war and ultimately to whatever Israel's articulation is of victory. And because that isn't being clearly communicated, it's becoming increasingly difficult to sort of see where all of this is leading. And I think that is trying the patience of Israel's allies and also the patience of public opinion in the world.
And I'm wondering if this is going to irk the White House, because yesterday Admiral Kirby says we won't support a major ground operation in Rafah. And the news we got overnight is that they were there in the center of Rafah. Could this be potentially, given your years of experience with the White House, a final straw for the Biden administration?
So I would be surprised if it was a final straw for the Biden administration. And oftentimes, what is said publicly is different than what is said in back channels. But, the U.S. support for Israel, appropriately so, runs very, very deep. And although we are seeing, increasing upticks in frustration with Israel, I think everyone in the White House continues to remember, who started this war and the strategy that Hamas has prosecuted since the war's outset on October 7th, which has been one to basically take the entire civilian population of Palestine hostage, to create situations in which civilian casualties are likely in order to turn global opinion against the Israelis.
How much do you see, Elliot, as this goes on, an increasing divergence between the United States and Europe? We saw, for example, Norway and Ireland recognize a Palestinian state. We've seen it with respect to also the Ukrainian conflict as well as Iran, a real kind of discrepancy between a European view and the U.S. view. Do you see this as something that is materially widening in the past few weeks?
I do, and I think that by design, again, the attacks on October 7th were made to elicit a certain type of response. And part of that response, too, is to place strain between Israel's allies to show where there was daylight. And so as much as this is a war that's being prosecuted very locally in Gaza, it's also a war that's happening on a much broader stage. And we've seen the strain that is existing between the U.S. and some of its European allies, and also, fears that have existed since the war's outset of a regional war in the Middle East. So it's an incredibly delicate situation.
You can see that clear in present daylight within the electorate as well, Elliot, playing out on the streets of some of the major cities of these countries as well. If I may, I want to talk about Iran as well. The Wall Street Journal reported yesterday that the Biden White House is pressing allies not to confront Iran on the nuclear program. Annmarie asked the question yesterday, and I think it's the right one. Just what is the policy of this administration towards Iran? Elliot, is there one?
Well, it would certainly seem to be a rather incoherent policy right now. And it would also seem that incoherence follows on many, many years of appeasing the Iranians. And the Iranians have their fingerprints all over current events in Israel and in Gaza. And right now, it would seem that kind of a stronger hand against the Iranians would probably be the better course, particularly considering just sort of the weakness that exists within the regime. Sometimes we set up Iran as though they're 10 feet tall, and they aren't necessarily 10 feet tall, and we should treat them accordingly.
Elliot, thank you, sir, for that final word. Elliot Ackerman there. On the latest in the Middle East, Annmarie, you asked the question yesterday. Far more important this morning after that report in the Journal.
And far more important after we also reported that Iran increased its stockpile of near bomb-grade uranium. This is the problem, and the United States doesn't want to potentially go out to Iran and, put more sanctions on there, enforce the sanctions they have. Very different policy than the Europeans actually want to see right now.
They're unwilling to take a strong position on this, Lisa, because they're unwilling to disrupt, or at least risk disrupting, the global energy market. And a lot of people might say, possibly you'd agree with them too, that this is about the oil market and gasoline going into the election in November.
That's why people are drawing a parallel between their stance on Iran, I'm talking about the White House, and how they're pulling away from European allies, as well as their stance with Ukraine not going after assets in Russia, energy-related assets in Russia, diverging from some of also the European allies on that front.
Brent crude, 84.90. We're up by 0.8%. Coming up very shortly, we'll catch up with Bloomberg's Genza Bazaja as the party of Nelson Mandela faces its toughest election since taking power in South Africa. That conversation is coming up next from New York City. This is Bloomberg. You seen this new hybrid from BYD? Listen to this. the range, capable of travelling more than 2,000 kilometres without recharging or refuelling. So this is like New York to Miami without recharging or refueling.
Okay. On one hand, you could say if you really were committed to the transition to electric vehicles, you would welcome BYD to come in, and all of a sudden your range anxiety would go poof, and then at the same time, what else would go poof?
Didn't even get to the price, $13,800. This is what we'll talk about with Tom Steyer a little bit later this morning, in about 60 minutes' time. Should we be embracing China's comparative advantage to deal with some of these climate-associated risks, given that they can manufacture a car that goes 2,000 kilometres without recharging or refueling, and they can do it for $13,800?
Well, you need to decide at the White House, do you care more about climate change or do you care more about union jobs and potentially national security concerns when you look at electric vehicles and some of the data potentially in these smart cars?
Paul Romer, who is the chief economist over at the World Bank, typically somebody who would celebrate the idea of internationalism and global trade, talking about how there is a necessary pullback in trade just simply because of how some of the globalism was executed before and some of the mistakes made. So the question that I have is, what are the correct lines given how we weigh different goals, right? If you want this transition to electric vehicles faster, well, maybe you have to give a little on this idea of what competitive advantage China has in the oversupply. If you prioritize the way we get there, well, how much do you have to push back your vision of a truly electric fleet of vehicles?
The answer you'll get from a politician is everything we can do all at once. Just sitting here and watching how this plays out, it is clear there is a hierarchy of objectives, and you laid some of them out. The number one objective is getting re-elected in November. And if you embrace that $14,000 vehicle, you're not getting elected in November.
Especially because if you think about Michigan, that is the key state to really be catering to. And Michigan is watching this very carefully and does not like the idea of a $13,000 electric vehicle that can go from New York to Miami without being recharged, that is being subsidized by the Chinese government. And it's going to drive them out of work.
And not just Michigan. Where's the president today? This angst about China potentially taking U.S. jobs? He's in Pennsylvania. Once again, the president is speaking in Philadelphia.
And this story is top of the agenda, big time. Equities right now in the S&P. Welcome to the programme. We're positive by 0.6, or rather negative by 0.6 on the S&P. On the Nasdaq, similar move lower. On the Russell, we're down by 1 full percentage point. Nvidia's been an island, and maybe we can sit on that just for a moment. We've had 3 days of gains, and we're up 20% over those 3 days. A massive company, $2.8 trillion in market cap. We've added close to 500 to that in just 3 sessions. And if I told you that, Lisa, going into earnings, you would have said this equity market would have ripped alongside it. And it just hasn't. And it's been really surprising to see that play out.
NVIDIA's win has been NVIDIA's alone. And to me, this is the fascinating point. They are a winner-take-all story. They're not necessarily a harbinger of this transition to artificial intelligence, saving all of the other industries in the same kind of way. To me, front and center, the reason why I was emphasizing bond auctions was because front and center very much is Fed policy again. The fact that Fed policy can shift around the equity market, which, you know, James Athey had some strong words about, really tells you how much uncertainty there is baked into and lack of conviction among a lot of equity investors.
We'll get into the bond market in just a moment. This is what Peter Schiff of Academy had to say. I'm not sure how many people had Nvidia up roughly 10% with the Nasdaq 100 down on Thursday. That certainly wasn't a scenario I thought was plausible, yet it happened. Then he said this: it makes me wonder about market participation and liquidity, those two issues.
Especially at a time where everyone's at the beach, as Annmarie was mentioning. But it raises something else that people are talking about. There's fake liquidity right now in the market, especially with 0 days to expiration trading, especially with some of the ETFs. There's basically this feeling that there is volume but not liquidity. People are trading, but are going to step away if there is true volatility that really does leave people uncertain about the outcome. That's a fear people increasingly have. It's with the stock market and it is with the bond market.
Well framed. Massive move in Nvidia. A shaky move yesterday in the bond market too. Lisa alluded to that, so let's talk about it. Here's the 2-year, 10-year, 30-year on a session. The 2-year getting closer to 5%, pulling back just a little bit this morning by 2 basis points to 4.9539. Going through yesterday, it was 4 days of yield shifting higher at the front end of the curve. On a 10-year, getting closer to 460, 455.99. If you missed yesterday's session, we had a couple of soft auctions. Lisa, we'll get another one a little bit later. $44 billion of 7-year notes.
At 1 p.m. today, Eastern time, at a time when the long end really is a point of real questioning. We've already seen the sell-off disproportionately hit the front end with the idea that maybe the Fed's going to have to remain higher for longer, but that will ultimately bring down inflation. What happens if people start talking about structurally higher inflation and a yield premium based on the deficit, based on whatever else you want to throw in there? Yesterday, dealers were stuck with the second highest percentage of 5-year auction notes since September 2022. You can get this feeling people have uncertainty on the front end, on the mid end. What about on the long end?
Speaks to some nervousness, and if you're seeing that at the front end, then the 7 years is going to be interesting.
Exactly.
A little bit later. I want to finish on foreign exchange. The one to watch for the euro today is German CPI. We'll get that number at 8 Eastern time, so about 90 minutes or so from now. So look out for that. The euro going into it just a bit softer at 108.42. This one's been quiet, but dollar yen just beneath the radar, getting closer and closer to 160 here, Lisa. 157.25.
And the move with the yen versus the pound has just been extraordinary, weakening to the weakest going back to 2008. There is a feeling right now that Japan doesn't have a lot of oxygen to move. They're talking about maybe having to hike rates later, but really moving slowly. At what point do they have to start worrying about it if it's just this sort of slow grind back to 160? Are they okay with it, essentially because it isn't disorderly, or do they have to step in, especially with Janet Yellen's kind of, scepter of angst, hanging over them saying, stop it, warn us.
Don't sell treasuries. 157.25. Isn't that what that's about?
Basically.
Probably. Under surveillance this morning, shares of American Airlines falling in the pre-market. The company cutting its profit guidance heading into the crucial summer travel season. In a separate announcement, American announcing its chief commercial officer is leaving the company. Some people suspicious as to whether these two things are connected, with that stock down close to 9%.
There have been complaints that this is the person who basically is a chief revenue officer. It's called chief commercial officer. And how do they sort of get revenues that are commensurate with some of their increase in costs? Other airlines arguably have done a better job. That is the reason why their revenues are coming in lower, even as a lot of people are talking about a really robust travel season. You asked the question, John, and I think this is the crucial one. How much is this American Airlines story, and how much is this a broader airline story in general? Guidance from United and Delta are going to be really important on that front.
Well, to that point, Jeffrey says that management is in a strong situation when it comes to cost management. They're in a strong situation, but their top line lags their peers. It also comes under a day, and Jonathan, I know you've been looking at TSA, how many people they've screened. People are still out traveling. TSA screened over 10.5 million people over the weekend around the United States. That's up about 8% from last year's Memorial Day weekend.
Kind of shocking to hear those numbers and then have American Airlines coming out of the long weekend cutting the outlook, but that's where we are and that's where the stock is. Elsewhere in the bond market, talk lots about this. Treasuries slumping after debt auctions for 2- and 5-year notes drew limited interest, and the Fed's Neil Kashkari said rate hikes are still on the table. You're going to get a bit more Fed speak later from Williams and Bostic later on today. Williams at the Economic Club of New York tomorrow, plus the beige book and an auction for $44 billion of 7-year notes. So 3 things on the table. Williams Volume 1, beige book, 7-year notes. Bramo, take your pick.
7-year notes, I think, are going to be most important just based on the price action of yesterday. Potentially, the New York Fed's Williams is going to be fascinating, especially because what Mike said. Typically, when it is a New York Economic Club speech, this is where they often issue some sort of policy shift or a broader statement. And I am curious about some kind of new framework that they use to analyze economic data that Loretta Mester was talking about. Is that something that's going to be kind of codified by Williams?
I'm with McKee and Lisa. It's got to be the double dip, the second inning of Williams that I'm interested in at the New York Economic Club. But also, PCE is Friday. Remember when we waited every single day to see what PCE is? This is what drives Powell. It's coming out on Friday. What does that data potentially say to the Fed?
Looking forward to that number in a couple of days' time. I want to turn to China just briefly. The IMF raising its growth outlook for the country to 5% for the year from 4.6%. The fund revising the outlook after a better-than-expected start of the year and added government support. The raise also coming despite an ongoing slump in the housing market, which is weighing on domestic demand. Also an upgrade for next year, too. There is a hope that maybe this continues.
Especially with some aid from the government in terms of buying up some of those empty homes to try to cushion the housing market. And we heard that from Geeta Gopinath as well, the first deputy. What's her first deputy managing? Basically, she's one of the heads of the IMF.
Helpful, Bramo. Still early, 6:39.
Well, what is the title?
First
People still in
managing
bed.
director.
Oh, thank you.
There you go.
Thank you. First deputy
Didn't you
managing
interview her
director.
like a month ago?
I know. She was
Come on.
wonderful.
Get it
I view her
together.
as the intellectual leader of the whole group.
Let's hope she's not watching. In South Africa, this morning at least, just for that little moment of this programme. In South Africa, voters heading to the polls in the closest election in the post-apartheid era. The African National Congress facing its toughest fight since taking power in 1994. Bloomberg's Jen Zabazaja is in Durban with the latest. Jen, it's wonderful to catch up with you. I know you've been anticipating this moment for quite a while. Just help us understand how big this moment is for the country you're in.
That's right, John. I mean, really, when we think about just the position of South Africa as Africa's most industrialized economy, but take a look at what the past few years have been, this is really shaping up to be an election where voters are really going to cast their vote for an economy that they think they need to see here in South Africa. And so if we just take a look at where the economy has been, 33% unemployment, much of it amongst the youth. There have been issues around electricity, port and rail infrastructure has been a problem and really hobbled any sort of economic growth in this country. And in particular, where I'm at in Durban, it has the busiest port in sub-Saharan Africa, but you wouldn't know that based on really the growth projections and the numbers that we've been seeing lately. And so, just saying all that, just to contextualize really how frustrated South Africans feel, but at the same time, as you were mentioning there, John, the African National Congress has been the majority ruling party here in South Africa since the end of apartheid back in 1994. That has been 30 years. And so this could really be a seismic change for this country if this is the first time that they're going to have to form a coalition with another party.
Jen, what would it actually mean if the ANC loses its parliamentary majority, given the fact that they've been in power for more than 30 years?
Exactly. There's a few scenarios that we are playing out, Annmarie, when we think about this. So, the ANC could potentially retain this 50% majority, and there's not so much of a change. Even marginally below that, we're taking a look at the ANC potentially teaming up with some of the smaller parties and not necessarily having to concede to a lot of demands from a smaller party. The big question is what happens if they dip below 45% majority, because in that case, they would then have to find a way to team up with some of the bigger opposition parties who could then potentially demand some ministerial positions or other positions. And so that's really what investors have been focused on in the lead up to this election, because if we do see potentially that dip below 45%, we could really see a change in terms of fiscal and economic policy moving forward. But, if we just take a look at where the RAND and also bonds have been lately, it is not the base case scenario to see the ANC, the ruling party, team up with a populist party like the EFF that is trying to nationalize the Reserve Bank and mines. But the question is, how are voters actually going to vote today? And then how will that then affect the economy and policy moving forward?
Hey, Jen, good to catch up. Looking forward to the results and hearing from you over the next couple of days. Jennifer Zabazaja there of Bloomberg in South Africa on the latest. South Africa did something really interesting. The president, Ramaphosa, he basically gave a new term to Lesetja Kganyago at the South Africa Reserve Bank. And when I caught up with him in DC, to basically insulate the institution from the election cycle. Now, this is an emerging market, sensitive to those concerns. We're seeing things happen in places like South Africa that maybe people would like to see here in the United States, and that's not going to happen.
Basically, there was an understanding that in order to have a more developed market type of economy and to protect the independence of a central bank, you had to do a move like this. At the same time, to your point, that people are speculating maybe there would be a Federal Reserve that loses some of that independence with another term, albeit unverified, in terms of actual policy. But you're right. I think a lot of people are looking at this as sort of a bellwether moment.
A sensible moment in South Africa. Let's give you an update on stories elsewhere this morning. Here is your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. U.S. pharmaceutical group Merck is reportedly buying iBio, an eye drug startup. The FT says that the deal is worth $1.3 billion of an upfront payment, with a further $1.7 billion dependent on certain milestones. They said in an interview with the iBio CEO, Merck declined to comment. Famed short seller Jim Chanos is being sued by one of his partners. Chanos is accused of taking $10 million in loans from the company over more than a decade and using them as a, quote, piggy bank. The lawsuit from Conlin Holdings also accuses Chanos of selling a Miami luxury apartment for $17.8 million and then using his girlfriend as the sales agent to net her more than $500,000 in commission. Chanos tells Bloomberg that the lawsuit is puzzling and baseless. Elon Musk's XAI startup has locked in yet another investment. This time it's Cathie Wood's ARK Venture Fund, which has purchased a stake in the nascent AI company. The stake represents about 2% of the fund's holdings. Last month, the fund disclosed a position in OpenAI that made up about 4% of its holdings. ARK's chief futurist said that AI foundation models are going to be worth multiple trillions of dollars by the end of this decade. And that's your Bloomberg Brief. John.
Danny, thank you. Much more from Danny in about 30 minutes' time. Up next on the programme, a divided consumer.
We're bullish on the consumer globally. There's nothing that suggests we're in any kind of approaching a cliff for the consumer.
Jay's bullish on everything. I mean, come on.
Well, basically said, if you bring him together with Dan Ives, it's like
bullish everything
yeah,
with,
exactly.
Bright colours and fireworks. That's next on the programme. You're watching Bloomberg Surveillance. On the S&P 500, pulling back just a touch. On the S&P, we're negative by 0.6%. In the bond market, yields a little bit higher by a single basis point on a 10-year, 456.19. Under surveillance this morning, a divided consumer.
We're bullish on the consumer globally.
Yeah.
We think there's a fully employed workforce, wage gains, and we're not believers that the consumer is going to create a problem, either here, Europe, or elsewhere in Asia. There's nothing that suggests we're in any kind of approaching a cliff for the consumer.
Here's the latest. US consumer confidence unexpectedly rebounding in the Conference Board's latest gauge of sentiment. Despite the increase, confidence trending lower in recent months, with the UMich sentiment index standing at a 6-month low. Amanda Lynam of BlackRock writing this: the US consumer remains notably bifurcated. This helps explain some of the conflicting data points released about the financial health of the US consumer in recent months. Amanda joins us around a table. Amanda, good morning to you.
Good morning. Thank you.
Can we talk about that contradiction in the economic data? How's that showing up in markets at the moment?
Yes. So I think just to frame it from a broad perspective, you've got a consumer, the top 20% from an income perspective, generating nearly 40% of spending. 87% of them are homeowners. At the lower end of the spectrum, obviously contributing a much lower percentage of spending, more likely to rent. In certain markets, that matters less. In this market, it matters a lot because you've had home prices up 49% using the Case-Shiller Index since December of 2019. You have borrowing costs for consumers that are in a net debt position, pretty elevated in terms of credit cards. And then you have equity market gains for the consumers that are in net asset position. So that bifurcation has always existed. There's always a high end and a low end in terms of income. But in this market, we believe it's mattering more. Now, how it's showing up in corporate credit, actually, ironically, sectors like retail have been outperforming the broader index in high yield. In IG, it's a little bit of a different retail mix because you've got kind of mass merchants and home improvement in retail. So I don't view that as kind of a discretionary spending, but you've got leisure, retail outperforming in high yield. So there's definitely a cyclical tilt to outperformance in corporate credit, especially in high yield still, despite this. And I just think it speaks to this kind of bifurcated consumer where you have the low end in a net borrowing position, so really getting squeezed, in the high end in a net asset position and really doing well.
So basically for the low-income worker right now, they're not going to be saved. That's what it sounds like, because we're not seeing any kind of credit stress that would prompt authorities to change policy.
I think that's right. And just like in credit, where we're not banking on significant interest rate relief, we're not really seeing that in the consumer as well. That would obviously be the same policy rate. The Fed has told us as much. And the Fed speak, I think, can swing the narrative day to day. But in general, I think there's just not an urgency to cut. And even when there is the start of a cutting cycle, we're expecting it to be shallow.
This to me raises a question, and I liked how John put it. They're not going to be saved. How long can this kind of divergence keep going where there's a cohort that's really feeling pain and that is struggling with an increase in delinquencies and defaults and an inability to rent, to completely being locked out from the housing market without there being some material distress that causes some sort of policy response?
So two things I would note. One is the New York Fed data gave some data on this a couple of weeks ago, where a significant portion, around 18% of U.S. consumers, are using 90% or more of their credit card availability limits. So it just goes to show you that they're really stretched, and a higher than normal share of those are transitioning to delinquency. So 30% of that is transitioning to delinquency. So I think that speaks to the stress. Banks are telling us that they're expecting consumer-related net charge-offs to peak in 2024 and decline in 2025. Some of those banks are reserving for a 5% unemployment rate, for example, so higher than where we are now. I think the bar is high for Fed intervention or policymaker intervention due to run-of-the-mill credit stress. I think where we saw the Fed step in the 2020 episode, for example, was when capital markets were freezing, when there was a concern about credit availability at any cost. I think that's really kind of the dividing line.
I'm thinking about Tom Sisouris of Strategas yesterday, and he was saying that he actually thinks that inflationary pressures are going to return next year, in part because of wage negotiations. I'm thinking about that lower income cohort that's really on their back right now. And why wouldn't they ask for bigger raises? Why wouldn't they say, we need higher costs, we need higher incomes in order to survive in this kind of environment? And oh yeah, if you're earning so much from the top decile of income earners, you can afford to pay us more. Why wouldn't that be what happens?
Right. And I think one of the really interesting data points that you often hear referenced is that the share of the U.S. economy isn't that heavily weighted towards unionized employees. That is true. However, if you are working at a competitor of a unionized employee and you see unionized employees get wage gains, would you not, to your point, start to kind of comp your own compensation relative to that data point? So I don't think just looking at the share of unionized employment is as many do, representative of, okay, well, there's a cap on wage pressures. Actually, I think it's a lot more translatable across the broader economy. But I think this is the point also that is the pain point in Europe as well. It's the domestic services inflation, largely driven by wages. And I think they've just been slower to normalize. They've definitely improved, but probably still running ahead of the Fed's 2% target, even if baking in an expectation on productivity. And so I think it's part of the reason why there's not this sense of urgency to cut from the Fed, just given some of these, I think, tail risks on inflation, but then also just in general a pretty strong growth backdrop.
When you look at the high-end consumer, the low-end consumer, what about the middle class? Have policy basically whittled out the middle class?
Well, I think if you look at so I gave that stat of the top 20%. If you look at the top 40% of consumers, they generate 61% of spending. They're still more likely to be homeowners. I think it really is the highest of the high-end consumer really driving disproportionately the spending. But to your point, I think in general, you kind of have this bifurcation of, are you in a net borrowing position or a net saving position or net asset position? And that's really what is the driving factor in terms of the consumer health.
So where do you see potential cracks, though, in the consumer? Because we heard from a bunch of retailers. They say that consumers are looking to trade down. In Walmart's case, even the consumer confidence report, it was better. But all the write-ins, basically, people are talking about they're struggling with higher food prices.
Yes, for sure. It's really in that lower end. And I think that's really contributing to the dispersion that you're seeing in the credit market, at least for us, is that dispersion even across sectors, but also within sectors, is really picking up. So if you're a retailer, for example, it matters what category are you in, what customer are you targeting, what channel are you selling into. All of those things really matter. But I would say, Annmarie, it's those customers that are in, those consumers that are in a net borrowing position that can't rely on equity that's accumulated in their home, can't really rely on savings. They don't have the financial cushion to handle an emergency expense, for example. Those are all things that we're watching.
So super thoughtful framework. Now the question, what do I do with my money? Where do I put it in credit markets?
So I think a couple of things. For choice, we're still preferencing floating rate exposures over fixed rate because I think that long end of the curve is a bit of a wild card. Within IG, I actually like moving down into triple Bs. And we've seen actually triple Bs outperform their higher quality single A counterparts like banks and IG. In high yield, that sweet spot is kind of in the single B range. The double Bs are more duration sensitive, so be mindful. They're definitely still not chasing triple Cs. There are definitely pockets to put money to work, but in buying credit, you need to be buying for income, not total return.
Got it. This was fantastic. Fantastic. It's good to see you, as always. Amanda Lynam there of BlackRock. Basically, I'll make it very simple. You either own a home or you don't. Is that what it comes down to?
Especially at a time where rent is going up pretty dramatically. Yes, because ultimately you are sensitive to those rising rates if you do not own a home because of that translated into rent costs. If you own a home and you've locked in 3% mortgage rates, it potentially is a different story.
If you might have done that.
I knew where you were going with this. I'm just saying,
obviously.
Yes, well,
There's some real stress out there.
It is.
That's for sure. Coming up in the next hour on this programme, we'll catch up with Victoria Fernandez of Crossmark, Henrietta Treyz of Veda Partners. Looking forward to this. Tom Steyer of Galvanize Climate Solutions and RBC's Amy Wu Silverman. All of that and a whole lot more. Equity futures down by 0.6% on the S&P. Yields on a 10-year getting closer to 460, 456. We're up a single basis point. From New York, this is Bloomberg.
This rally is about earnings growth. Earnings growth has been remarkable.
That mega cap growth trade is still quite expensive. It's still quite crowded, and it's got decelerating earnings growth.
Being overweight tech, given that it's 30% of the index, to me seems almost reckless.
Its utilities have been under-owned for a very long time.
The whole thing that the AI is going to lift everything, I think that story's run its course.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance begins right now. Live from New York City this morning. Good morning, good morning. Equities right now pulling back by 0.6% on the S&P 500. Your lineup looks like this. A little bit later on, the beige book will be released. You'll hear from New York Fed President John Williams. Look out for that. And Bramo, top of the pile for you, I know. $44 billion worth of 7-year notes coming to market after twin auctions yesterday came in a bit soft.
The fact that they came in soft and they're short end of the yield curve, they're basically short-term bonds. The fact that people did not clamor for 2-year notes, to me, indicates a bit of exhaustion or lack of clarity around what Fed policy could be. I understand maybe the idea of a rate hikes isn't exactly the base case, but still having that even openly discussed by Fed officials makes some people nervous.
It's worth saying it wasn't just the soft auctions, it was also the economic data. An economic data that maybe traditionally you wouldn't put a ton of weight on, rather like the PMIs of, say, last week. It was the consumer confidence number that started to show a bit of a bounce. We bounced back that too. And I think that reinforces the hawkish Fed speak. It's not that there was anything new from Kashkari. It's just that when you say it and the data backs it up, I think it turns the volume up on it just a little bit more.
Consumer confidence unexpectedly on the rise, for the first time in 4 months. What I would say, though, when you look at what Data Peterson says, the chief economist at the Conference Board, according to May's write-in responses, consumers cited prices, especially for food and groceries, as having the greatest impact on their view of the U.S. economy. So, yes, some are a little bit less downbeat about the outlook of the economy, but still, this theme is not abating. This is the idea that prices are still too high for many people for their basic needs.
All I can say is, remember how we were talking about S&P global PMIs suddenly shaking a market? The idea that Conference Board consumer confidence that looks basically like a heartbeat, it's like zigging and zagging across the screen, could really dictate where people are at, gives you a sense of just how susceptible people are to anything that can confirm a narrative on a given day that otherwise seems rather listless.
That's the Fed speak and the debt auctions. Let's talk about the deals. This from Conoco to buy Marathon Oil in an all-stock transaction. This is what they have to say. The deal enterprise value $22.5 billion US dollars. This is Conoco buying Marathon Oil in an all-stock transaction. Bramo, we've seen this a few times already over the last 12 months or so. Exxon, Pioneer, Chevron, Hess. Here's another one in the mix.
What's fascinating to me is there's no debt in this deal. I remember back in 2014 during the shale boom, it was all driven by the leveraged finance market. Now this is driven by fundamental strength and by stock. This is a much more financially stable industry that is gearing up for even more production later on. I was speaking with someone in the oil industry yesterday who basically said there isn't really a limit to the production of shale. A lot of the technology is actually increasing the potential production much more to a much greater degree, which raises a question: if it's 13 million barrels now of U.S. production, what could it be in a year's time?
It expands their footprint in this domestic shale. This is a resurgence almost of American oil and gas under a president who once called them what, John? Stranded assets? We're north of 13 million barrels a day for a president who wants to be the cleanest, most pro-climate president in history, and we have record U.S. production.
Conoco's been super acquisitive. Through the pandemic, the same thing. I remember they took Shell's assets in the Permian as well. Getting some more details, by the way, if you are just joining us. Conoco's going to buy Marathon Oil, all-stock transaction. This is what they have to say about buybacks. Buybacks to be over $20 billion over the first 3 years. They go on to say, Bramo, that the deal will immediately add to earnings and cash from operations. That stock is down by about 1.9%. Marathon is up by about half a percentage point.
And we were asking about how much more of this would we end up seeing, and it looks like quite a bit. Conoco is down just a touch in our early market trading. But to me, what this indicates is how much more of this tie-up can you expect, especially given that maybe this administration will be more amenable to allowing some of these transactions to go through in order to create that resilience in the face of some of the geopolitical threats that remain pretty much looming large.
More on that story throughout this morning. If you are just joining us, I want to get to the broader price action as well for you. The scores look like this on the S&P. We're negative by 0.6%. Yields are higher by a single basis point on a 10-year, 456.19. This hour, we'll catch up with Crossmark's Victoria Fernandez as stocks fall on hawkish Fed comments. The co-founder of Galvanize Climate Solutions, Tom Steyer, with an optimistic view on climate change. We'd love his thoughts on that deal this morning too. And RBC's Amy Wu-Silverman on the market uncertainty around the November election. We begin with our top story in the market. We're stuck in the Fed waiting game. Stocks falling on the back of hawkish comments from the Fed's Neil Kashkari. Victoria Fernandez of Crossmark writing this: we continue to see volatility in the markets as the uncertainty surrounding the rate path in the US remains high, keeping us cautious as cracks in the labour market begin to appear. Victoria's with us right now. Victoria, let's start with the sustainability of this uptrend. Are there question marks around that now, given that we've seen a big move in the biggest name, the most important name in this equity market? 3 days, 20% gain for Nvidia, and this equity market more broadly has done nothing.
No, I think you're absolutely right, Jonathan. And Nvidia is kind of playing a game all by itself over there in the gains that we're seeing. But you look at the rest of the market, and there are some concerns. Look at the diversification and the difference between the Dow and the transports. That's worrying to us. Transports have been coming down pretty significantly. That's usually a key indicator and a leading indicator of what we're going to see in the markets. And so we're seeing that divergence come there. We're seeing cyclicals no longer being leadership. We're seeing other names start to come up. Now, cyclicals are becoming leadership overseas, so we're starting to see a pickup over there, but pulling it down here. And look, a couple weeks ago, Jonathan, when we were talking, you said, Victoria, where's the weakness in the market? And we've started to see that now since we spoke last time. You're seeing weakness in the consumer. Look at retail sales. We are actually flat with real retail sales over the last 4 months. Regional PMIs, regional manufacturing reports are weaker as well. There's different weaknesses that we're seeing. Housing also, we've got a 5% gain in housing prices right now, which again, all of this feeding into the idea that the Fed is going to be very uncertain in its path forward. And I think that's why we'll have a volatile market going forward.
Victoria, sometimes it's difficult to draw a distinction between a single name issue and a broader sector problem. Great example of that this morning is American Airlines. The name is down by more than 8%. They've had to cut the outlook. How would you distinguish between a single name issue in that sector and a broader sector problem?
Yeah, you have to really take a step back and look at what's going on across the board. When we look at airlines, and you know we're not strong holders of airlines in our portfolios, but when you look at American, they have had some idiosyncratic issues going on there. We know that they have a key individual leaving. That person was responsible for some of the revenue generation, especially around the credit card issues that they were having, where they have not succeeded like United has done, like Delta has done. So there are some issues specifically for American, but you also have to wonder if that travel sector that had such a huge comeback after COVID, if that's going to start to pull back as we see the lower income and the middle income consumers really struggle. I know in the little montage that y'all played, there were different voices in regards to whether consumers are doing well or not, but we are seeing those lower and middle income consumers struggle both in the balances they're carrying spending on their credit cards. You've got almost 60% of those lower and middle income consumers carrying balances. And now they're turning to the buy now, pay later, which doesn't even show on their credit reports. That's a whole nother issue where almost 10% of those people are using it to buy necessities. So it tells me we're going to be struggling with the consumer. So that could flow through to the sector as a whole going forward.
It raises the question, what does it mean to be cautious? And we hear this a lot. We're cautious, moving up in quality. How do you even determine what that is? Is that just to continue to buy NVIDIA because they run the world? Is it to go into utilities that are increasingly thought of as an artificial intelligence play and that have been bid up? Or is it to go into the oil patch, which is often thought about as actually leverage to the consumer but seems to be dancing to its own music? How do you view caution in a new world?
So, Lisa, I don't think it's a specific name or sector when we say we're being cautious. When we're looking for high quality names, for us, that's in regards to the dependability of their earnings, the quality of their earnings, the cash flow on the balance sheets. I mean, you look at the energy story you were just talking about with ConocoPhillips. I mean, they can do these deals because their cash flow is so high and so strong. It gives them the opportunity to make these acquisitions like Marathon. So you want to have companies that have that cash flow, those earnings. That doesn't have to be in one sector or another, but I do think it means you have to be stock picking. You can't just pick a sector like you previously and say, oh, tech is doing great, let's go in. I mean, you look at healthcare, for example, it's been down pretty significantly, but you can find a specific name like Gilead that we own, where you've got, a stock trading at less than 10 times price to cash flow. You've got almost a 5% dividend and you've got strong earnings. Those are the types of names that we think fit into that cautious scenario.
It seems like a lot of cylinders in the United States are working for it in terms of the tech plays, NVIDIA, among some of the others. We're talking about oil. All of a sudden, oil prices going up is actually not necessarily so negative for the United States. It actually is becoming an increasing exporter and sort of more self-sufficient. You're looking at even some of the drug innovations, albeit maybe the obesity drugs launching from certain European countries. But I'm just curious, from your vantage point, is the U.S. still the place to be cautious in?
Yeah, look, we want to see some exposure in our clients' portfolios to international because, like as I mentioned earlier, we're seeing some of the cyclicality in the market, some of those cyclical names, discretionary names, doing better outside the U.S. So maybe you start to dip your toe in some of those international markets that are doing well. But when you look at the U.S., I do think you have to take that cautious approach. And it doesn't mean you're not invested in the market. We are in the market 100%, but you have to be careful as to where you're putting your money to work. Does it make sense to dump everything into those Mag 7 names? Well, probably not. We think we'll see some earnings deterioration in those names over the second half of this year. And other areas like utilities, like healthcare, will start to pick up. So being cautious just means be careful where you're putting your money to work. But we do think being in the U.S. makes a lot of sense. Dipping your toe in other markets starts to make sense as we're seeing cyclicality pick up.
When you look at the hedge fund exposure to big tech, the Magnificent Seven that you're saying potentially you're seeing a little bit of cracks in, 20.7% of hedge funds' total net exposure to U.S. single stocks. That's what they account for now in these Magnificent Seven. Do you think that's way too much?
It seems really strong, right, Annmarie? I mean, you look, top 5 names in the S&P 100 are almost 30%. And you look at semis, that's 11% of the S&P. A few years ago, it was only 2%. So we've had this tremendous amount of growth in those names. It is one of the reasons why we remain cautious. Do we have exposure to those names? We do, but we're underweight versus the benchmark. So you want to be able to take advantage of some of the gains there, but also be a little underweight because we do think we'll see a pullback, and it gives us a little dry powder when we trim those names to go into other areas of the market. So it does seem pretty heavily weighted. And as we all know, there's a difference between their weighting in the S&P on their market cap and their weighting in earnings as well. So you have to look at that difference and decide where you think it's the best place to be.
Hey, Victoria, busy morning. It's good to catch up as always. Victoria Fernandez there of Crossmark. The broader market right now is negative 0.6%. There is a deal we need to get you an update on with your news, your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John, that's right. ConocoPhillips is buying its smaller rival Marathon Oil in an all-stock deal, the enterprise value of which is $22.5 billion. Adding Marathon will give Conoco control of assets in Texas, Oklahoma, North Dakota, and the Permian Basin. The transaction is expected to close in the fourth quarter of this year. Elsewhere, Elon Musk's XAI startup has locked in another investment. This time it's Cathie Woods' ARK venture fund. It purchased a stake in the nascent AI startup. The stake is about 2% of the fund's holdings. The purchase comes a month after it disclosed a position also in OpenAI that makes up roughly 4% of its holdings. ARK's chief futurist said that the purchase, that means that now AI foundation models are going to be worth multiple trillions of dollars by the end of this decade. Chinese car maker BYD unveiled a new hybrid powertrain that's capable of going 1,250 miles without a recharge or a refuel. That's the equivalent of driving from New York to Miami. In a live stream event, the automaker announced that it will use the new tech in 2 sedan models that will cost under $13,800. Now, for now, it'll go into made-in-China cars, but they're likely to be exported soon. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny in about 30 minutes. That story presents the perfect question for politicians right now. Should they embrace that or not?
If they want the transition to electric vehicle futures, well, you don't have range anxiety here. You don't have a lot of the potential negatives that a lot of people are talking about, and it's affordable. On the flip side, if you really do believe this is a new era of industrial policy, it becomes really problematic to embrace a Chinese vehicle.
Even if, and the producer actually wrote this in, it makes a lot of sense, even if it's 100% tariffs on this car.
Not sure it stops it.
Does that? It's double what? It's $11,000, $14,000?
Yeah. I'm not sure that's going to make a big enough difference. Tom Steyer, by the way, 15 minutes away. He'll have thoughts on this, I'm sure. Up next on the program, the White House holding the line on Israel.
The president doesn't make decisions and he doesn't execute on policy based on public opinion polling or on popularity contests. He bases his decisions on our own national security interests.
That conversation just around the corner. Live from New York City this morning. Good morning. Live from New York, welcome to the program. Equities right now down by 0.7%, off by about 0.66 to be precise. Yields bleeding a little bit higher again. We're up 2 basis points, getting closer to 460, 456.98 on a US 10-year. Under surveillance this morning, the White House holding the line on Israel.
The president doesn't make decisions and he doesn't execute on policy based on public opinion polling or on popularity contests. He bases his decisions on our own national security interests, what's at stake for our safety and security here at home and abroad. Sometimes what's in the best interest of your alliance and your partnership is to be candid, forthright, even tough with your friend, which we have been able to do with Israel.
So here's the latest. The White House saying it will continue sending arms shipments to Israel despite the IDF's deadly strike on an encampment in Rafah. President Biden opting to stand by Israel even as he's facing increasing pressure from voters in his base. Henrietta Treyz of Veda Partners writing this. In states where there are substantial college graduates and college towns and disproportionately large populations of Arab and Muslim voters, Biden is actually doing better than he is elsewhere in the nation. Henrietta joins us now for more. Henrietta, I'm pleased you've brought this subject up. You see it in the polling. It's so clear. It just makes you wonder how relevant what is going on in the Middle East is to what's about to take place in November.
Yeah, that's exactly the right way to frame it, I think. When you're watching a protest on TV, it feels all-encompassing. And if you're, a senior about to go off to Colombia, it's a very important component of your decision-making process. But for the average American, this is just not a factor. Americans are famously not attuned to foreign policy. The president's commitment to Israel has been pretty unshakable. The last major bipartisan piece of legislation that will pass until November was specifically to provide aid to Israel, a battle that President Biden fought for 7 months with the House Republican Conference. So the commitment to Israel is plain. American support for the protests and any kind of effort to denigrate Israel domestically is at 23%. It's a very small subset of the United States. And the bigger areas of concern are plainly from your polling data and others, are plainly on other issues. And I think one big one is going to supersede the narrative this week, which would be the conclusion of the Trump trial. The reason I point that out is because just a few weeks ago, 22% of Indiana voters decided that they wanted Nikki Haley to be the nominee, not Donald Trump. And it was primarily in suburban, white, affluent, married areas. And the disparity between support for Trump and between men and women was about 10 points, from men favoring him and seeing more favorable news cycles from him and maybe tuning out the court trial, to 10 percentage points more of women seeing some bad news about the former president in the last week. So those are some of the data sets that in your polling and others is really stand out, as opposed to the Israel-Gaza conflict, which is going to continue to recede in voters' minds, especially as we head into the summer months. And it'll pick back up in October and November if it's still going on. But the president's line is pretty plain here.
Henrietta, it could take hours, days, weeks, potentially, until we know what the conclusion is going to be of this Trump trial. But can you map out potentially what the strategy is going to be from the Trump camp and the Biden camp if Trump is convicted?
I can't really speak to it. I think the Biden team is actively trying to be more fly by the seat of your pants, sort of, let's see what happens. You know, they threw out Robert De Niro yesterday in sort of a last minute ad hoc press conference. I think that's going to be the approach, the design. And I think to tie this into the decision about the debate, the design is to break through the media cycle. So whatever they can do, they had largely been ignoring the Trump trial. And I think the Fox News audience has a different narrative around the Trump trial. And what the Biden team is basically acknowledging with their debate is, hey, we are not breaking through either moderates to maybe adverse Republicans in the Trump camp right now, to RFK Jr. voters, even to Democratic voters, particularly youth voters, to try to get out this message, whatever it may be, in a way that breaks through that they have not been able to do for the last year.
We do see the president trying to break through when it comes to the blue wall. The Philadelphia Inquirer talking today about this is Biden's third trip to Philadelphia and sixth to Pennsylvania just this year alone. Is it working?
This is exactly the issue that the Biden team needs to work on. And it goes back to John's question earlier. The Nevada, Arizona contingent is so much further underwater for Biden than the blue wall of Michigan, Wisconsin, Pennsylvania, that it is plain and I think good campaign strategy for the Biden team to really focus on the Rust Belt. You just did a segment, and we'll do another one on the electric vehicles coming in from China. Those tariffs are extraordinarily popular. Whether they're effective or not is one thing. An export control ban, an import control ban would be highly effective. A tariff is just a one-time hit, a tax that you pay. You know, as you point out, if you're going to pay for that car in the first place, you're probably comfortable paying 100% tariff. You want the certainty of it. But the path to the Rust Belt and the path to winning for President Biden is straight through those blue wall states right now. And that's what they really need to concentrate on shoring up. So I'd expect to see Biden there more than, say, Nevada or even Georgia or North Carolina.
Henry, I want to sit on the electric vehicle question for a minute, because we were talking earlier about how it's really difficult to get a handle on how we rank some of the priorities of this administration. Arguably, if inflation is the number one issue for a lot of people, the idea of a $13,000 new car that can be charged once and drive from New York to Miami sounds pretty good. How strong is the support for tariffs at the expense of higher inflation, and how clear is the message right now from this president?
Well, I think you have to focus on what the tariffs actually do, especially if you're going to have the inflation conversation. It's the tariffs on components that are a lot more inflationary because they go into so many more vehicles, as opposed to this new flash in the pan, fancy vehicle that's coming in, it's untested, and maybe you can get from New York to Miami. But how many people are really trying to do that on their electric vehicle? So the tariff on imports of whole vehicles, of which there are not that many imports, is very different than the tariff on components. I would say that it continues to be our view here at Veda Partners that the the export control restrictions around semiconductors, around investment, around what components can go in and outside of the United States and potentially travel to China is far more punitive than any of the tariffs that they could put on. So when Ambassador Tai pulls together a whole of administration effort on challenging China, you see it in sanctions, export control restrictions, tariffs, but not just on the final vehicle. That's more flashy, but a very small fraction of actual imports, kind of like the steel tariffs. They put a 3 times higher tariff on steel, but that's only 2% of the imports that we have here in the United States. So it sounds big. It's really the component pieces, and I think the export control restrictions that are much more impactful.
We were planning a whole show around this. We were going to expense the new BYD, $13,800. Brammer was going to drive us from New York to Miami. Lisa, that was the plan.
Yeah, evidently, because am I the only one? No, you drive, right, Annmarie? No. Okay, I'm the only one who drives.
I have a license. I'll
be driving.
Hence why I said you'd be driving.
Exactly.
Henrietta, thank you. Henrietta Treyz of Veda Partners. Wally Adeyemo is going to be joining Bloomberg TV a little bit later. Don't miss this. Joe Matthew, Katie Lyons, the US Deputy Treasury Secretary. Lisa, my first question would be, why shouldn't we embrace that car?
Especially if inflation is really a problem and we want to make this world a greener world that embraces electric vehicles. It's a really important question.
More on this in just a moment. Annmarie is going to go away early this morning. Good for you. Hopefully you'll be back with us tomorrow.
It's jury duty, so I do hope I'll be back with you tomorrow.
Tom Steyer on the other side of this commercial break. Looking forward to that from New York. This is Bloomberg. Live from New York City this morning. Good morning. Equity futures on the S&P 500 look like this. We're down by 0.7%. The score is shaping up as follows this morning. And good morning to you. The Nasdaq's down by 0.75%. The Russell down by 1 full percentage point. It's amazing to see this equity market not rally, given what has happened with Nvidia. 3 days and a gain of 20%, and a move in this market cap of something like $466 billion US dollars, Lisa, in one stock. One company. We're now looking at a $2.8 trillion market cap.
Can we fairly say it's the Magnificent One? Can we fairly say that stop it with the Magnificent 7, Magnificent 6, Magnificent 5? And we've gone down the whole range now. There is one big winner, and it is Nvidia.
What about the other 499 on the S&P 500? Struggle.
Especially given the fact that they seem more susceptible to higher yields. People said they're rising for the right reason. Well, that seemed to sort of be challenged a little bit in the past couple of weeks, albeit a quiet couple of weeks. But this idea that maybe suddenly it doesn't really matter why they're rising, but at some point it's going to bite if the Fed really doesn't really respond to the strength, to any kind of weakness by cutting rates.
That's the equity story. Here's the bond market picture for you. We'll snap up the yield curve, 2-year, 10-year, 30-year. Looks like this. The 2-year is at 496. We've had a move over the previous 4 days higher, in by about 2 basis points this morning. On a 10-year, up by another single basis point. Lisa, getting closer and closer to 460 at 456.59. 2 auctions soft yesterday. You've pointed towards the 7-year auction that takes place a little bit later this afternoon. That's a test for this market.
$44 billion of 7-year notes after softer than expected auctions on the front end. Remember how everyone was bullish in the belly of the curve? Let's go medium term. We can't go all the way out, but medium term, it's going to be a positive environment. There's no way we're really going to have 5% interest rates over the next 5 years. Well, maybe not, right? And suddenly the fact that you have softer than expected auctions there just paved the way for that much messier of a 7-year note experience this afternoon. I think it's really important. I mean, yes, it is not a liquid market right now. It's summer. Everyone's away and barbecuing at the beach houses. But still, I'm watching that.
Coupled with better than expected data last week on the PMIs and yesterday with consumer confidence. Under surveillance this morning, here's the lineup. Fed speak with Williams and Bostic on deck today. We'll also get the beige book at 2 p.m. Eastern time. That all following comments from Neil Kashkari that the Fed hasn't completely taken a rate increase off the table. I'm not sure what I thought about those comments yesterday. I think he's kind of stating the obvious. That's basically what they've told us repeatedly over the last few weeks anyway.
They can't take anything off the table. I agree. I think just the tenor of it maybe moved the needle. I think more it was the auctions, though, and the consumer confidence coming in at 102 versus in the 90s as people expected. I'm with you. I think that it's just sort of on the margins, not necessarily that significant based on this prior rhetoric.
More Fed speak and look out for that auction a little bit later this afternoon. Just a quick update on the latest in the Middle East. The White House saying Israel's deadly airstrike in Rafah didn't cross President Biden's so-called red line. It comes as international condemnation grows following the attack, with French and German leaders calling for an immediate ceasefire. And elsewhere, Anglo saying it won't give BHP any extra time to commit to a takeover, likely spelling the end, for now at least, of the $49 billion deal. The takeover would have created the world's biggest copper producer at a critical time. The metal is seen as the key to the energy transition, with annual demand set to double by 2035, according to a study by S&P Global. Joining us now, I'm really pleased to say, is Tom Steyer, co-founder of Galvanize Climate Solutions and author of the new book, Cheaper, Faster, Better: How We'll Win the Climate War. And I've got that book alongside me. Tom, good morning to you.
John, how are you?
I'm good. This is a hopeful book. This is constructive. Can you walk us through the essence of what I'm holding this morning?
Sure. I mean, Basically, what I'm saying is that the news from the natural world about climate change is worse than most people know. And we read that virtually every day. There's a new study saying, do you know what's happening in the Amazon? Do you know what's happening in Antarctica? Do you know what the temperature is around the globe? But what people don't know and what they don't see, but what I see all the time as an investor, is the technology response. And what we're seeing is an amazing response in terms of the ability for clean products to win in the marketplace on their own. That's why I called the book Cheaper, Faster, Better. That you have products that people choose of their own volition for their own reasons, and that's happening across the globe. What we say in the climate response world is we're not looking for a silver bullet, we're looking for silver buckshot. Literally hundreds of ideas, hundreds of companies that in fact are going to solve this problem in the marketplace. We're winning in the marketplace, and we really have to keep that momentum up.
Do you think government is helping or getting in the way?
Well, I think I'm sure your question really is focused mostly on the United States, and I think the Biden administration has passed a series of legislations that most Americans do not know anything about, but which are designed to make clean technologies, the production of them and the sale of them much faster. And so in that way, the U.S. government has helped a great deal. But what's true is this is an international problem, and we really need international cooperation between countries with America in a leadership position so that we have the same rules, the same standards, the same measurement around the world.
Let's talk about one industry which is in the headlines every single day, and it's EVs. And you know where I'm going with this. We've talked about this all morning, this new BYD hybrid with a super long range of 2,000 kilometres, $13,800. And the policy of this administration and the next one of its, Donald Trump Volume 2, is going to be to put up the walls, make it really difficult to buy that car. Do you think China has comparative advantages to tackle the things that you're concerned about that we should embrace?
So I think that China has a very troubled economy, and they are using the power of the government to try and win in the clean energy arena to create jobs and some economic momentum. So do I think that BYD gets advantages, that in effect it is unfair competition between BYD and American car makers? Sure, I absolutely do. Do I think that a $13,000 car that you can drive to Miami from New York is a game changer in terms of clean energy? I also think that. Do I think you guys have been talking, we're just talking all the time about, I think they call it inflation. It sounded like the 1980s in this room. Every single
70s.
I mean, crazy attention to every single bond auction.
Yeah.
Okay, well, you think a $13,000 car makes a difference in terms of the inflation equation? Absolutely it does. So when we look around the world, this is a global problem. It requires a global solution. China is the biggest emitter by far, almost a third of global emissions. It is also the country which is focused on winning this from an industrial standpoint, leading in terms of solar panels, EVs, and everything else. So, as far as I'm concerned, from an American standpoint, we have to compete in this. This is critical for us, game on. But everything we do in that will, in fact, help save solve this crisis.
There is ultimately a question, though, about industrial policy in places like the U.S. and Europe is less efficient than, say, having it all in a centralized place that's perfecting it. It's not advantageous to us competitively, but it isn't necessarily going to advance the aim of trying to get to a cleaner world if everyone has their separate industrial policies that's competing and duplicating all of the processes. I mean, how much do you sort of embrace just some of the cheap goods, and how much do you say, no, national security trumps some of the environmental concerns, at least for now?
Absolutely, I get that. I mean, at my heart, I'm a believer, maybe it's from my Econ 101 courses decades ago, I'm a free trader in the sense that, the world produces the products in the places where it's best to produce those products, and American consumers get the advantage of that, and we do the things that we do best. And, the issue is, okay, that's how the world equilibrates. China is dumping. That means they're giving us stuff very, very cheap. That's really hard for us to compete with sometimes from an industrial standpoint, but from a consumer standpoint, from an inflation standpoint, from an environmental standpoint, that's a gift to the world.
So do you think that there is too much of a sort of industrial policy on a regional basis and they should just embrace free trade? Or do you think that right now is a moment to lean into developing and competing on a domestic front, even at the expense of the advancement
well,
to
what
some of
I
these
can
climate
see,
goals?
when I talk about silver buckshot, that is hundreds of companies doing hundreds of different things, and all of them growing like a weed and creating a lot of jobs. So I'm not worried about the United States' abilities to compete. I know we can compete. And I think when I look around the world, I mean, let's just take a step back.
Sure.
Cars. You guys want to talk about cars. What is the car company in the United States that has grown like a weed, that's worth hundreds of billions of dollars, which isn't in Detroit?
Tesla.
Okay, so if we're really trying to protect the status quo, which is what I hear you guys saying, is we need to protect the status quo, the existing companies, that's really hard to do. Like, the companies that are going to succeed are the companies that are going to be on the cutting edge of the cheapest, best, cheaper, faster, better. Okay, let's produce the cheaper, faster, better products, and what we're saying is we need to protect these jobs that exist in companies that aren't evolving fast enough. Now, is it true that China's dumping? Yeah. And when you say they have better industrial policy, I would, excuse me for saying this, but really, because I take a look at a little deeper at their economy and say, well, they've really messed things up to a fare thee well.
To this point, how much can this be done from central planning? You know, especially through the idea of subsidies for electric vehicles at a time when a lot of people are saying hybrids probably are the better, more ecologically friendly vehicle.
So then they'll buy them. That's my point. How are we, I say, cheaper, faster, better, how we'll win the climate war? In the marketplace.
Yeah.
Letting people make their own decisions. I don't like central planning. You know what? I think 330 million Americans are smarter than any group of central planners in the world, including in Washington, D.C. Let the American people decide. That's why I love capitalism. It's dispersed decision making. It's like democracy in economics. Human beings get to make their own choices for their own reasons, and they're smart. And that's how we're going to win. That's how we're going to save ourselves. And that's what we've traditionally done. We've done that.
We've heard some automakers compare and complain about some of the things you're talking about. And I think it is important. The automakers are saying ultimately we want to leave it to the marketplace, but the government is setting these targets that we can't reach because the infrastructure does not exist yet. Are we getting it back to front? We got it the wrong way round. What would you change tomorrow about the policy towards, say, EVs and the build out?
Well, everybody's focused. To be fair, you guys are really focused on EVs, which is playing to 3 companies in the United States that are very old, that in fact did not lead the EV revolution, in fact tried to push back against the EV revolution for a really long period of time, right? And the company that actually leaned into it was the one that
Tesla.
sells many more EVs than any other company in the United States. So doesn't that making my point? That in fact it's about innovation, it's about change, it's about being in the front with the product that is in fact cheaper, faster, and better, that's how we win, and that trying to protect people from those forces. You know, I always say to people, when people say what'll happen if there's a Republican administration, I say you can't stop people from buying the cheap, good product. It's the old story about King Canute putting his throne in the middle of the waves and telling the waves to stop coming in. Yeah, good luck. That you can't do it, right?
So do you think we're overemphasizing the importance of who's in the White House for this transition?
No.
And if that's the case, should it matter who we vote for?
It's important, but not for the reason you're saying.
Go on, tell me why.
Because what I'm saying is economics wins. The good products, the cheap products win. But this is a question about global response, not American response. We're seeing it through American eyes. This world is a lot bigger than the United States of America, and it takes it. And so we need international cooperation so that the Chinese companies are held to the same standards as American companies. So that around the world, okay, China is trying to win this industry. They're by far the biggest emitter of greenhouse gases, and their greenhouse gases went up 5% last year. Their greenhouse gas increase was more than the world's increase. So let's be clear. If we do the international cooperation, that's how we get a level playing field. If we measure emissions so people know right down through their supply chain, that's how we get every company on the same playing field. Under a Republican administration, do I think that will happen? I would be very skeptical that a Republican administration believes in international institutions, in international standards, in building the information systems to make all of that possible.
Maybe I'm revealing too much, but I remember being a 10, 11, 12-year-old and learning about the deforestation of the Amazon and not being able to sleep at night. And then, as I got older, reading all of these things about global warming and just that we were all evil and, all contributing to the rapid destruction of this globe. And it made me kind of tune out after a while, because if I wanted to sleep at night, I wanted to feel like I could actually have a normal life, it was hard to even pay attention. How much is that making it difficult to really get people engaged, to really get the investment strategies to continue with ecological sorts of focuses? Because we've seen a lot of pullback from that.
Well, Lisa, that's why I wrote the book.
To help Lisa sleep.
Well, pretty much. And to say that I deserve to get paid for it, I'm not even going to go there. It goes without saying. For goodness sakes, John, that's obvious. No, my point is this. Look, there are two big memes in America about energy and about decarbonization and climate. And the memes are, one, we're an oil and gas driven society, and that will always be true. That is not true. That is absolutely not true. Every country in the world, every single country in the world has agreed we need to get off oil and gas, that we need to get off fossil fuels. And the second one is we're in a doom loop. Like, we are destroying the natural world. We can't stop ourselves from destroying the natural world. All these terrible things are going to happen. And the point of my book is, no, this is a huge struggle that we all need to join in on. But we have the tools and the abilities to win it. We will inevitably win it, but we have to win it as fast as possible, basically to create a safe society, to avoid almost unimaginable human suffering, but also to have American lead a new century in terms of doing the right thing and winning. So in terms of the Amazon has been providing a service to the rest of the world for free forever. It's the so-called lungs of the world, and 30% of it's in drought now, which is a huge, problem. But what we need, if we have the international measurement systems that I was talking about, basically it's a system for trying to measure value being created and trying to move money to compensate people for doing all the things they're doing for each other for free, and charge people for doing all the things to hurt other people for free. That's really what we're talking about changing in this world.
Tom, this was thoughtful stuff, and hopefully we can catch up again before November and have a bigger conversation about this election. Thank you, sir.
Just remember, we can win this. We will win this. We should keep our chins up and let America do its job.
Tom, thank you, sir. Tom Steyer there, the author of the book, Cheaper, Faster, Better, How We'll Win the Climate War. Let's get you an update on news elsewhere this morning with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Shares of American Airline are falling in the pre-market trade nearly 8.5%. It cut its profit guidance heading into the crucial summer travel season. Airlines are now finding that the revenge travel boom from the pandemic is giving way to a more cost-conscious traveler. In a separate announcement, American also said that its chief commercial officer is leaving the company. Some deal news for you. U.S. pharmaceutical group Merck is reportedly buying iBio. It's an eye drug startup. The FT says the deal will come in the form of a $1.3 billion upfront payment and then a $1.7 billion future payment that's dependent on certain milestones. They cited an interview with the CEO of iBio. Merck declined to comment. Officials in Iowa have detected the biggest outbreak of bird flu in 2 years. The deadly disease was found in an egg-laying chicken flock and is believed to have affected over 4 million birds. It's the first detection of bird flu in Iowa since December, and the state is the country's top egg producer. It has about 12% of egg-laying hens. The virus has already been infecting dairy cows across the U.S. And that's your Bloomberg Brief. John.
It's one story I can't even read about at the moment. Danny, thank you. Up next on the programme, the fog of November.
We want to be forward-looking. There's a lot of fog out there. There's a lot of clouds. And we're all just stuck talking about the Fed.
That conversation up next, live from New York. This is Bloomberg. Equity futures right now negative 0.6% in the bond market, shaping up as follows. Yields high yesterday, again this morning, up 2 basis points on a 10-year, 457.18. Under surveillance this morning, the fog of November.
U.S.-based investors, again, are struggling to come up with the salient differences from an investment perspective between the two candidates. And we want to be forward-looking. There's a lot of fog out there. There's a lot of clouds. And we're all just stuck talking about the Fed.
Here's the latest. 538, newest polling showing former President Donald Trump leading President Biden by 1.5%. As of last Friday, it's Trump's largest lead since April 2nd, when he was ahead by the same margin. RBC's Amy Silverman writing this. Historically, markets tend to run up during US elections. One exception is if the outcome is unclear. There is a hump baked into the VIX term structure for US elections. However, there is no hump baked in for the idea that we could have a prolonged 2000-style situation where the results are not immediately known. Amy's with us around the table. Amy, good morning.
Good morning.
Are you suggesting there should be a hump further out?
Potentially, yes. You know, look, I think one thing we've talked about a lot is just the complacency we've seen in the markets, in particular the left tail. And there are a lot of scenarios, in particular with this election, where there are so many unknown unknowns of what is going to be policed out, that, you know, the idea that maybe that hump in VIX term structure should extend a little further, I think is certainly one worth exploring.
Are you actually actively pitching that to clients, that this is something that they should really think about? Or are you sort of worried about being perceived as political in any way, shape, or form when it comes to this whole narrative of trading?
You know, it's interesting. I think the one good thing about options is you can be a little apolitical in the sense that you just simply talk about magnitude, right? And not necessarily that we say one outcome happens or another, but just the idea that maybe that outcome is prolonged. But that said, you know, I think it's tricky these days to pitch something very long dated. And part of the reason is investors just want to know what's happening 30 days in. This has only been exacerbated by zero data expiry trading. But, you know, I think actively we're talking about the short term, but thinking about the long term.
Do you think that people are not really pricing in the presidential election at all, that there's sort of like a de facto hump out there, just sort of as a cover your bases kind of moment, but that people haven't really embraced it in a real way because, as your colleague Lori said, it's like staring into the sun?
It absolutely is. And I'll tell you, you know, we speak with investors a lot, and the same investors who I would tell you 5 years ago would prepare for something like U.S. elections, their tenor, their horizon has shrunk down to maybe a week. They're now trading CPI, PCE with 3 days left to go. It's like turning in your homework super late. I mean, that's what we're seeing. And the market structure is allowing you to do this, right? It's allowing you to do this. So why sit there and burn the premium? So I do think we're going to kind of get to elections and be like, holy cow, what do we do to prepare?
I just want to pick up on something you said. Do you think that explains why we've seen some of the price action we have seen off the back of some of the data points we've had, like PMIs last week, that we struggled to explain? Do you think everything's become super short-term focused?
It absolutely has. And, you know, one thing I'll tell you is when you look at just the at-the-money straddle break-evens in front of some of these core data points, they have gotten larger when you kind of look at historical quarters. One, obviously, because the Fed continues to say we're data dependent. But two, people are just trading those more with, you know, 1 day to go or maybe a few days to go. And I think that is exacerbating these very, very tight moves, but not necessarily these longer tenor moves.
There's another move in this equity market we've struggled with, and I'd love your perspective on things. Nvidia. We've had this move of 20% in 3 days on one of the biggest names in the market with a market cap of $2.8 trillion. Alicia and I were talking about this earlier. If you'd said that a week ago, I would have said this market on the S&P, we're up by 3-4%. Big rally, big move higher off the back of that. It hasn't happened. Have you got an explanation for that? What's going on there?
So I think I do, because this is something we've actually been talking about for a while, probably ad nauseum at this point, but we said it even prior to NVIDIA earnings, which was you're not seeing that right tail sentiment anymore. So the tailwind in the options market has really been sucked out. We saw this exuberance peak in March, but in NVIDIA and in the market as a whole, that right tail gain that we saw all of last year and the beginning of this year has gone. And even after NVIDIA earnings, which were quite good, right, and it beat its options implied move, we didn't see it reignite either. So look, there's no left tail really. It's still relatively inexpensive, but that momentum on the right side has really, really flagged. And I think that's very important.
Does that indicate to you that there's more downside risk, especially in light of a greater macro focus and the idea that there was a much more negative response to the possibility of higher yields for longer in the past couple days?
So I'll say two things. I think it's a little nuanced in the sense that I think there is less upside risk because that right tail has really flagged. You're not going to get that exacerbation of gamma. But second, that left tail still remains inexpensive. And I do think there's safety in the kind of trades now where you could sell that upside safely to fund downside. Whereas when NVIDIA was roaring and all those adjacent names were roaring, you really couldn't do that because you could have been blown out on the right side.
The stock is up again this morning by 0.9% in early trading. Equity futures are down by about 0.6. Amy, it's wonderful to hear from you. As always, Amy, Will Silverman there of RBC. Coming up in the next hour, here's the lineup for you. Sonal Desai of Franklin Templeton. We'll catch up with Scott Devitt of Wedbush, Renmac's Neil Dutta alongside Tony Rodriguez of Nuveen. Sonal Desai, Lisa, with some thoughts about what's happening in this bond market. We've heard repeatedly that that's where the risk is for equities. We heard that from Mike Wilson of Morgan Stanley just last week. And then the auctions of yesterday, putting even more emphasis and attention on the auction a little bit later this afternoon.
Especially at a time where even shorter dated bonds haven't really sold that well. Here's the question. How much risk is there in the equity market from higher yields for longer, and where? Is it just going to be ongoing consolidation in small caps, or does it start to broaden out for the rest of the 499 names?
At the long end, yields starting to pick up there. Saw it yesterday, again this morning, up 2 basis points on a 10-year, 457. On a 2-year, getting closer and closer to 5%. We've had 4 days of yields rising at the front end of the curve. Make it 5, up a single basis point on a 2-year yield this morning. That's the bond market. Equities pulling back just a touch on the S&P 500, down by 0.6%. In just a moment, German inflation. The euro, 108.47, negative by 0.1%. From New York, this is Bloomberg.
I don't think the Fed is, at this point, in any need, nor are they being compelled to move rates in either direction.
The hawkish case for the near term is do nothing, and the dovish case is anything different than that.
We could get too much easing before inflation makes its way down to more stable zone.
Perhaps they will find an opportunity to initiate a rate cut this year, just depending on how the data, particularly the inflation prints, play out.
There's a little bit of downside risk to this market, and I think that's underappreciated.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, very focused on debt auctions in the last 24 hours. Bramo has edited the script this morning, so here it is for you. 7-year notes later, $44 billion worth. That's going to be the main event this afternoon, following those 2 soft auctions yesterday, $70 billion of 5-year notes and about $69 billion of 2-year notes.
I love pulling the strings. I feel like I'm just sort of, quietly orchestrating in the back of the room. I did think yesterday when the auctions came out, this really was the most important moment of the day, especially as you point out with some of the consumer confidence numbers that came out hotter than expected and a hawkish tilt to some of the Fed rhetoric. Key question to me is going to be how much of these auctions and the indigestion or sort of uneasiness around them is really going to come back to the deficit, because we've been talking about this. The deficit, does it ever matter? At a certain point, if you start to see weaker than expected auctions with this expectation that inflation is going to keep coming in later this year, you have to ask what gives.
Yeah, the big test later this year, November. I think that's the time in everyone's diary on the calendar, November in this election. And how does this bond market respond to proposals from the 2 candidates? If you get a Republican sweep, this is what Bill Gross and the FT is concerned about. He believes that Trump is the bearish candidate, directly because of what he thinks is going to happen in the bond market off the back of it. And this is exactly what Mike Wilson of Morgan Stanley said. The risk for equities is in bonds, and it's about whether treasuries reject this deficit of 6% of GDP. And my question would be, typically in bad times for developed market economies, when the economy rolls over, you buy what? You buy treasuries. If we're running a deficit of 6% now, what does that blow out to? Will we fund that in quite the same way? And we'll see. We'll see. And I think most people conclude we will, but the risk is we won't.
We're not hearing we will fund it from any candidate. We were talking about that yesterday with our guests. There's no one talking about how we care about the deficit. It's all, we're going to create a stronger economy that's more competitive on an international level with more productivity, and we can grow our way into this deficit as the deficit grows at a faster pace than the economy. Here's the question. At what point does the bond market care? Is it already starting to care on the margins? Maybe it's not going to be a Liz Truss moment, but do you start to see that premium just creep in slowly and make it much more difficult to fund the deficit on the margins as a result?
Ashok Bhatia, Neuberger Berman, what did he say last week? There's a clearing price for this, and the rate's going to be higher. And it's why he doesn't like duration. He does not like long-dated treasuries, specifically because of this reason. I don't think that's a consensus view yet, but he's certainly getting company as the weeks go by.
We've heard that from other people, which is the reason why I thought it was fascinating that yesterday, the belly of the curve, the 5-year notes that we normally see quite a lot of bullishness around, actually saw weakness in this auction in terms of the total demand. This raises a question: at what point do people start to say, why? Is this really just because of inflation and where the Fed is expected to go, or is this something else that's going on?
The next 10 minutes of this programme dedicated to Lisa. Coming up, we'll catch up with Sonal Desai of Franklin Templeton on what she calls the twin roots of rising rates, Scott Devitt of Wedbush on his Airbnb upgrade as summer travel begins, and Renmac's Neil Dutta on why economic nirvana is still possible. We begin with our top story. Stocks falling, bonds retreating as investors digest hawkish Fed speak. Minneapolis Fed President Neil Kashkari saying that policy remains restrictive, but rate hikes are still on the table. This is the FOMC, and officials on it and investors await the Fed's preferred inflation gauge due out on Friday. Sonal Desai of Franklin Templeton is with us around the table for more. Sonal, good morning to you.
Good morning.
What did you make of the auctions yesterday? What did you think about them? Is that something to be concerned about on the margin?
On the margin. Because, look, you can't take the auctions and then take it all the way that this is the beginning of something longer. But, you know, I do think that longer term, we have to start building in more risk premium. The extent to which I would not agree with Bill Gross, who you were just mentioning, is actually I don't see it as a Trump versus Biden issue. What the CBO is talking about is over the next decade. It doesn't matter. That's the way I see it. It really doesn't matter.
One thing Lisa's talked about is that Liz Truss moment that took place in the UK, repeating maybe in the Treasury market. Would you put any weight on that?
If you had it, it would almost be better, because I think it might be the only thing which could bring the Republicans and the Democrats together to have some more sensible fiscal policy in this environment. Do I think it's a baseline? Actually, no, because otherwise we should have already been there. When we hear about promises to keep the Trump tax cuts for everyone making less than $400,000, that, people should be aware, is almost 2/3 of the cost of that package. So 2/3 or more of the cost of the original tax cuts comes just from there.
This raises the question of what is the cost of clearing, as John was mentioning. How much are you baking in an extra premium that you want to see on that longer duration bond before you're willing to buy it?
So I think about this in two pieces. There's what I think about as the mini cycle of Fed rate cuts, which actually makes some duration attractive, but for a very limited time, because I think that rate cutting cycle is going to be short, it's going to end early, and then the market is going to correct to that longer term environment, which I think looks a lot like pre-GFC, which means Fed short end is looking at around 4. You know, that is, we're looking, I'm talking about Fed funds, so literally overnight, 4.25, and the long end, fair value, build in a non-recessionary 120, 130 basis points premium even before that fiscal deficit.
Hold on a second. You're talking about structurally long-term 10-year treasuries being north of 5%. Is that correct?
Absolutely.
So how do you arrange now, given the fact that you expect short-term there to be a rally and then long-term for there to be yields much higher than most people had expected?
Well, I think right now we are very slightly long, but not really closer to neutral, that I would say, than to being actually long, because we don't think that a massive rally is going to be forthcoming over here. Essentially, you're clipping coupon, as far as I see this, in fixed income more broadly. I'm not anticipating that massive return coming from rate cuts during this cycle.
There was this belief that this economy couldn't really survive with a 10-year note north of 5%, that you would see some real pockets, in particular some of the corporate borrowers who had borrowed at very low rates. We've all been surprised and haven't gotten any answers as to why we have not seen that distress. Will we see it over time, or is it done? Has it been worked out through private credit and through refinancing and through, just general growth?
So I think that all of these factors have contributed, together with actually more sensible behavior on the part of corporates in terms of pre-financing, so on and so forth, pushing that maturity wall we all expected for next year and the year after. It's been pushed further and further out. And I think that is definitely contributing to what we're seeing. But ultimately, yes, at some stage, if we start seeing the this very narrow channel through which Fed policy is currently operating begin to have an impact, some easing in growth and so on is bound to happen. So you'd see a slight pickup, but I'm not anticipating a massive collapse here just because of 5.25% rates if we get there.
The phrase we've heard around this table repeatedly is survive until 25. Is that phrase no longer relevant, given what you just said?
I don't think that is relevant. This is, for me, definitely a new paradigm where, this
we can live with 5%.
We can live with 5%. Look, it's only 15 years. It's in the post-global financial crisis period that we all got really used to these ultra-low rates, and it all worked as long as you did, and, the last 6 years. We've been averaging 8% of GDP budget deficits. So, we have no idea how much this economy can bear, but certainly it can bear 5.25 when there is no outlook for a reduction in the fiscal deficit, which continues to support.
So in the previous regime, we talk often, you basically had two choices if you wanted income. You go further out along the curve, or you go down in credit quality.
Yeah.
What's changed for you? Is it easier? Is it simpler? Do you go back to an old playbook? What's changed for you just in terms of your approach with a bond market that offers real income now without much risk compared to 10 years ago?
Oh, look, spreads are incredibly tight. So one thing which has changed is, versus 10 years ago, you're not going to have everything rising together because you've got very little margin of error, I think, at this stage. Certainly, spreads being as compressed as they are right now in the high yield space, for example, it implies you have to be extremely careful in terms of picking your spots. That was perhaps less so 10 years ago.
So you're a bond gal. I get it. But every argument you're making kind of speaks more to stocks. At a time when you see growth and you see this idea of inflation and you see this idea of 5% yields not curtailing corporate activity, but maybe eroding the fiscal profile of the United States, how hard is it for you to argue buy bonds?
So, I'd say buy bonds relative to what you've done in the last 15 years. I am not saying buy bonds outright relative to equity. I'm not an equity person. But it's very hard for me to argue right now that bonds are going to give you the types of returns that people have become accustomed to with incredibly easy policy and Fed rate cuts and all this lovely stuff which just got handed out. I'm not talking about that. But having said that, it's a good diversifier. It gives you ballast to your portfolio. And hopefully we won't see the type of volatility once the market settles into recognizing what the Fed is going to do, as we've seen over the last year.
Can I pick up on one of those last points?
Okay.
As a ballast?
Yeah.
You still think the bond markets retain those risk mitigation characteristics?
Taking into account everything and the fact that yields will probably be somewhat higher, I think, yes, they are going to offer you that ballast.
OK. So now this was great. Thoughtful. It's good to see you in person too. Thank you.
Thank you.
Sonal Desai there of Franklin Templeton. Let's get you an update on stories elsewhere this morning. We can do that with your Bloomberg brief. It's Danny Berger. Hey, Danny.
Hey, John. On those German inflation numbers, they edged up yet again, underscoring the challenge facing the ECB as it prepares to cut rates next week. Consumer prices rose 2.8% from a year ago, higher than estimates, and up from the 2.64% recorded in April. The numbers are unlikely to deter policymakers from cutting rates in June, considering how well broadcast that's been, but may serve as a deterrent for subsequent moves. In deal news, ConocoPhillips is buying its smaller rival Marathon Oil. It's an all-stock deal with an enterprise value of $22.5 billion. Adding Marathon will give Conoco control of assets in Texas, Oklahoma, North Dakota, and the Permian Basin. The transaction is expected to close in the fourth quarter of this year. Abercrombie & Fitch gaining in the pre-market, up more than 1%. It beat and raised. It's a remarkable comeback from the teen fashion graveyard. Revenues rose for the sixth straight quarter to $1 billion, and Abercrombie boosted its outlook. The stock is up 73% this year at all-time highs. And that's your Bloomberg Brief. John.
Hey, Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the programme, the morning calls, plus Scott Devitt of Wedbush on his Airbnb upgrade as summer travel kicks off. That conversation just around the corner. Live from New York City, this is Bloomberg. The The opening bell about 1 hour and 15 minutes away. Equity futures pulling back just a touch on the S&P 500. We are lower by 0.55%. Decent close yesterday on the S&P 500. We were in negative territory, and then we closed higher by just 0.02%. But there was a gain towards the end of the session, Bramo.
Well, at a time when we did see better than expected consumer confidence. Okay. We realize this is obnoxious, but good news is good news, bad news is good news. Where do we really stand on this? Baddish news is good news. That's what we heard from Max Kettner. There is this feeling that if rates are higher for the right reasons, it can be something that stocks can tolerate.
James Athey earlier on this morning, James basically said, all news is good news for stocks until the labour market really breaks and unemployment shoots higher.
In fairness, it was spoken with the sincere frustration of having perhaps been a bit more bearish than perhaps some of the price action had been. And he said, maybe I should sit on a couch to discuss this. But there is this feeling of a lack of understanding about how much is fundamental, how much is momentum, and how much is just something else.
I think what you heard was a bond investor who just thinks the life of equity investors is much easier than his own. Anyway, time now for the morning calls. First up, TD Cowen raising its price target on Carver to 90, keeping a buy rating. The analyst pointed to strong first quarter results, staying bullish on the company's plans to grow traffic this year. That stock is down about 3%. Next up, Citi raising its price target on United Airlines to 96. The analyst noting that the stock trades below its pre-pandemic PE and keeping United on the focus list. That stock is down by 2% because of this. Jefferies downgrading American Airlines to hold with a $12 price target. Analyst Sheila Kaholo, good friend of this program, citing a cut in its earnings outlook and expecting sales to fall behind competitors this year. That stock is down by more than 8%. And we've asked the question all morning. Is this American Airlines or is it a broader airline story?
Their chief commercial officer left, and I really have to wonder, this question we've been asking a long time, are these airline companies or are they credit card companies? How much is the revenue profile of some of these firms basically going to rise and fall, and how well they could rope customers in with American Express and give them perks like access to the lounge, even above people who actually travel on their planes?
Delta? Just say it. Just say it. You're not talking about American right now, are you? You're talking about Delta.
Well, America didn't do a good enough job with their credit card, which maybe is part of the problem.
So I went in the Delta lounge a couple of weeks ago, right? I don't usually go to Terminal 4 or fly Delta.
I know.
But I fly Delta, trying to save the company some money. Sit in the lounge, right? And this guy comes up to me. It's half empty. Can't sit there. I'm like, why? He says, they're reserved. I said, reserved for who?
Right.
So I left. And that was my relationship with Delta. It lasted all of 5 minutes.
Reserved?
At the lounge. Reserved
I haven't
for who?
heard of
this
that.
Like roped off area.
Oh,
bizarre.
Wow.
And I said to the guy there as well, why is Terminal 4 such a mess? And do you know what he said to me?
What?
People love flying Delta, so the terminal's really busy. Honestly.
All right,
It's like,
okay.
Is this an airline or
All
a
right.
cult?
Well,
what is it?
Well,
an
if it's
airline or a cult?
If it's a cult, then you want to buy its stock. That's all I can say, because cults,
So busy in Terminal 4 because everyone loves it. Okay. Sticking with travel, Scott Devitt of Wedbush turning bullish on Airbnb, upgrading the vacation rental company to outperform with a 165 price target, noting near-term resilient travel demand and long-term growth catalysts. Scott, I'm pleased to say, joins us now for more. Scott, the floor is yours, sir. Let's start from the beginning. Why the upgrade and why now?
Good morning. So the upgrade's really premised on the pullback in the stock post-earnings. Airbnb always has traded at a premium. Since it reported first quarter results, the stock's been down about 10% versus its closest peer, booking up 10% and the NASDAQ about 4%. So that valuation gap has tightened, and the prospects for the business are as bright as they've ever been.
Scott, do you think this is execution, or more broadly, is this about leisure demand in this country holding up better than expected?
I think it's very strong execution. It's a founder-led company that's created a category. In addition, you do need a macro backdrop that's favorable. And as you highlighted before, consumers have jobs. The unemployment rate is low. Wealth has been created through the boom in the housing market and the stock market, and that tends to lead to travel. When and if that changes, it'll be a problem even for the best-run travel companies. That's not the case right now.
Scott, with all due respect, I used to love Airbnb. And then some of the add-on fees. You have to have, the cleaning fee that doubles it for one night. So you have to do more than one night to make it worthwhile. And then the taxes on top of it. You start looking at the comparison, and it's cheaper to rent a couple rooms in a hotel than going to Airbnb. How much of a competitive edge do they have at a time when there are all of these fees and restrictions in certain places that constrain supply? I'm thinking also New York City.
There's always sources of friction in New York City, as you highlighted. I think there's also anecdotes that may favor hotels. I have one recently that actually favored Airbnb about 60% of the cost of the competing 2-room hotel choice for a college football game coming up in September. And so I think that the gap tightens as the mainstreaming of a service occurs, which has happened with Airbnb, so that the price delta that existed, think Amazon in the early days, sales tax avoidance and lower prices, leads to convenience and other reasons why consumers gravitate to the brand. And I think you're seeing that right now with Airbnb.
How sensitive is Airbnb and some of the other players in the space to the consumer cycle? And how do you even identify what the consumer cycle is at a time where it does seem to be a tale of two different consumer bases?
There's no detaching the travel industry now, no matter how well run a company is, from the cyclical aspects of the economy. And travel is tied at the hip with the economy. And so I think you have to pay close attention to macro trends, consumer trends, and that will ultimately drive the success of even the highest quality travel companies. As I noted, right now, things are still good. Whether they'll be in 6 to 12 months' time will tell. I would note, as it relates to American, it's not probably the best run airline. You did have one of its peers reiterate its guidance, for the quarter. You did have good, very positive commentary coming out of the cruise industry in recent weeks and more broadly in the travel industry. So I'm not necessarily sure that what's happening as it relates to American is a canary in the coal mine, as they say, so much as it possibly is a company-specific issue at the moment.
Scott, this is such an important point, and it closes the conversation basically where you and I started it, on execution. I'm just going through the list of companies that fall under your coverage. Booking Holdings, Outperform, Expedia, neutral, TripAdvisor, neutral. When you're picking through industries right now, what is it about the companies that are doing well and the companies that you're not so constructive on?
We look for blue chip leaders, and in internet, blue chip leaders tend to create significant wealth. Many times they're founder led, or they have been and turned over to a very good operator. And in the travel industry, we highlight one in Booking that is not a founder led company, but it's been a phenomenal performer and executed well over 20 plus years now. And Airbnb, which is founder led, which has created a category and executed well in its business for many years as well. And if you look at our broader list of recommendations, that's really the case across the board. And my view, just in recommending, stocks one over the other, is benefiting from the compounding nature of the differentiation in business quality, and that's a significant factor in stock outperformance.
Interesting. Scott, thank you, sir. Appreciate the update following the upgrade. Scott Devitt of Wedbush on the execution you're seeing in the travel sector right now, and why, saw a mention of it right there, just heard it, why American Airlines might be an American Airlines problem.
And not a canary in the coal mine, as you said, given the fact that maybe the execution hasn't been that great. When you look through the travel companies, I wonder also how much of the haves versus the have-nots are arranged in certain geographic locations that are more skewed toward a certain demographic of consumer, right? I mean, if we're talking about a bifurcated consumer base, I do wonder how that plays out in a leisure sector where you see, ski resorts and other types of high-end vacation spots doing really well.
Go back to Amanda Lynam of BlackRock and what she said to us earlier this morning. There's clear bifurcation with the consumer. You don't see it in the aggregate data. And because you don't see it in the aggregate data, you're not going to see it shape policy anytime soon. So high for longer is going to stay. The low-income cohorts that are suffering because of this, based on what we're hearing from a lot of people this morning, will carry on suffering because their pain doesn't reach the surface. And until it reaches the surface, it won't set the agenda for policymakers in quite the same way.
And I'll take it a step further, because what I was thinking about as she was talking was, well, what does this mean for home ownership for lower income families? Not going to happen. Renting is going to be extremely expensive because of a lack of housing. Borrowing to get a car, incredibly expensive. Credit for a credit card. Also, I mean, you start putting this together and you start wondering, how do you ameliorate those stress points for one cohort that is so disproportionately affected while everybody else seems to be doing just fine? And I don't know what the answer to that is.
Broader conversation coming up very shortly on this. We'll catch up with Renmark's Neil Dutta and Nuveen's Tony Rodriguez. Neil breaking down the economic story and why things can improve and get better, the more optimistic view. And we'll catch up on the bond market perspective of things as well. Let's turn to the bond market right now. The scores look like this in the Treasury market. Going into that debt issuance a little bit later on this afternoon, the Fed's beige book, and of course some more Fed speak. Yields are higher by a single basis point on a 10-year, 456.39. And yields just creeping higher over the last week, Lisa, at the front end of the curve. All of a sudden, we're talking about 5% again on a 2-year at 496.
And it comes with better than expected data in the U.S. when it comes to consumer sentiment. But also today, I don't know how much the international story is also playing into this, but that's also played a role. German harmonized CPI actually came in hotter than expected, rising 2.8% year over year versus the estimate of 2.7%. So there is this feeling, even with the ECB cutting rates almost for sure in June, there is this feeling inflation is a harder thing to kill, not just in the United States.
That ECB meeting a week tomorrow. Full coverage of that right here on Bloomberg TV and on Bloomberg Radio. More still to come. Tony and Neil on the other side of this commercial break from New York City. This is Bloomberg. Equities right now in the S&P 500 negative by 0.6%. On the Nasdaq, shaping up as follows, down by 0.7. So weakness on the Russell, we're down by 1 full percentage point. We've said it a million times already this morning. Amazing to see Nvidia up close to 20% over 3 days, and this equity market not run with it. In the bond market, 2-year, 10-year, 30-year, the yield curve looks like this, 495.39 on a 2-year, pulling back by 2 basis points on a session. On a 10-year, up another single basis point after the move we saw yesterday. We had some weight to it. 456.39. And just to finish on foreign exchange, the euro looks a little something like this. 108.55, just about unchanged, Lisa, as German CPI year over year comes in on the margin just a little hotter than expected going into the ECB meeting next week.
What's amazing is this doesn't change the rhetoric at all. You still have basically a baked-in June rate cut, and you have the French head of central bank coming out and talking about how, you shouldn't discount a July rate cut as well, even though you still have inflation running hotter than expected. This is the advantage, or I should say, in quotes, advantage you have of an economy that's not doing as well as the United States, right? So even still, they're coming at a very low pace in terms of inflation as well as economic activity.
That first cut very likely to come a week tomorrow. Under surveillance this morning, ConocoPhillips buying its smaller rival Marathon Oil in an all-stock deal with an enterprise value of $22.5 billion. Adding Marathon will give Conoco control of assets in Texas, Oklahoma, North Dakota and the Permian Basin. The transaction is expected to close in the fourth quarter of this year, and we've seen Conoco do this repeatedly over the last few years.
And it's not just Conoco at this point. A lot of people have been getting into the shale consolidation trade. Really, one key question, especially as we've been talking about how a lot of mergers haven't been allowed to go through, that the antitrust sort of regulators step in. Not necessarily a question here. Raises this question about this administration maybe not feeling that bad about some of these tie-ups, considering the fact that energy independence suddenly is a real attribute.
They'll welcome that 13 million barrels of oil a day. They just don't like talking about it so much, depending on who you talk to in the administration.
A necessity to get us to the next phase at a time of a lot of geopolitical unrest.
One of those deals you're alluding to, it's Merger Wednesday, continues. Hess shareholders voting in favour of Chevron's $53 billion takeover deal. Chevron looking to secure a stake in one of the biggest oil discoveries of the past decade through Hess and its 30% interest in a Galvanize field. We've talked about that in Guyana a few times.
And how they really get in at a time of a lot of questions about who owns that and what Venezuela might want to do. At this point, there is this question of what are the marginal producers and how quickly are we going to actually get to peak oil at a time where we are getting more efficient vehicles. To me, it seems like the new idea is you can't get rid of oil. It's going to be part of this economy for a longer period of time. And so you have to invest in solidifying that so that you're more immune to geopolitical risks. So suddenly there's a lot more investment in fossil fuels. It's just sort of this counterintuitive moment compared to where we were a couple of years ago.
And the -2, can we find enough copper? Can we find enough copper? You, Mitch, when they came out with this study from Adam Simon, Professor of Earth and Environmental Studies. I'm going to go through these numbers again. If you've missed this, I'll share it again. A normal Honda Accord needs about 40 pounds of copper. The same battery electric Honda Accord needs almost 200 pounds of copper. Study goes on, and basically they conclude that the amount of copper needed is essentially impossible for mining companies to produce. 10 years ago, they used to get money and dig a hole. 10 years later, they were punished for that, big time. There was a big bust in mining. They stopped doing it. We need them to start digging holes again. It takes a long time to bring this copper online. It's not happening, and it's not going to happen fast enough.
This is the reason why copper has been a moonshot when it comes to pricing. There's a question, especially when we think about the interconnectedness of the world, where some of those copper supplies are going to come from, especially if there are some sort of fissures in the geopolitical order. How exactly a nation like the U.S. is going to secure those copper supplies versus China? And imagine they're in the same places and you get that competition. This is going to be really the focal point of a new sort of soft war in a way, and we've already seen that percolate with certain areas.
The copper absolutely surging so far this year. We've talked a lot about the bond market this morning after weaker than expected auctions for the 2- and 5-year notes just yesterday. We will get the Fed speak continuing today with Williams on deck and again tomorrow, Bostic as well, followed by the beige book and an auction for $44 billion in 7-year notes. Mike McKee with a little bit of a look ahead. Is this the appetite for Williams ahead of the main course tomorrow?
It could be, because he's speaking at the Economic Club of New York tomorrow, and he's going to have a text, and he's going to be presenting a case for something to do with the U.S. economy. So we're anticipating he'll lay out more of his views on where we are and when the Fed might do something. It's a roundtable commentary today up in Watertown, and so it may depend on what people ask him, which is kind of the way they get into trouble.
You want to get into the room, Mike, and plant your own question. You said just yesterday that Economic Club of New York addresses can be used to say something bigger about the moment we're in. What could that possibly be tomorrow?
It probably not a lot bigger than what we've already heard, but he could throw his weight behind the idea that we're going to have fewer than 3 rate cuts, because he hasn't put a number on it, and some of them have started to put numbers on it. He would probably repeat what he has already said about we're not taking rate increases off the table. That's nothing new from him. So at this point, there isn't much they can say beyond the guidance they've given, because they've pushed things out. And so there's not going to be a decision anytime soon.
They can't really give us more information because they don't have it. But perhaps Loretta Mester set the tone when she started talking about scenario analysis yesterday. I thought this was fascinating, the idea that maybe the Fed could do a better job laying out what data they look at and how they input it into different models and different structures to understand what exactly would be the threshold for either cutting or hiking. At what point do you think that starts gaining steam?
Well, it could gain steam fairly quickly if they are, as a group, interested. We talked about this yesterday about how they're going to be doing this review of their policy framework starting in the fall sometime. And it'll take probably about 6 months to a year. But that's the kind of thing they would be talking about. The scenario analysis would kind of replace the kind of odd guidance we get from time to time of this may happen or that may happen. Because the idea is, if you tell people, if this happens, here's how we think about it, then the idea is that the markets have a better idea of where the Fed is going when we get new data.
Yesterday, I was trying to get excited about the beige book. You poured some cold water on that. We want to reprise that conversation. Is there anything to look for in the beige book?
The same things. You don't have to sell it, Mike, if you don't need to.
No, I was just going to say that sort of the same things that we have been getting from companies in their earnings reports and from Fed officials who say they talk to people. We'll see what it says about inflation trends, whether companies are still raising prices, whether they're finding it hard to find workers. But this is the kind of stuff that's been out there a lot in a lot of different formats. So that's why they call it the beige book, I guess.
We know lots of Fed officials watch this program. Michael will be reading it. We promise you. Okay?
I will be reading it.
Michael's going to be reading it. Okay. Neil Dutta, Renmac, around the table with us alongside Nuveen's Tony Rodriguez. Gents, it's good to see you. Neil, let's talk about why you're still constructive on this economy. Why?
Well, I definitely think the trade-offs are getting a little bit trickier for the Fed. So I tend to think that, we're still at the end of the year going to be talking about an economy that's growing and how much has the Fed been cutting. I still think that's really the name of the game. But, I do think that, to me, it's not as obvious that, the Fed goes around saying, we have time, we don't have to worry about things. You never have as much time as you think in hindsight. And we know that the risks with unemployment are always that they're nonlinear in nature, right? So it's never just that unemployment goes up a little bit, it goes up a lot of bit, right? And so I think when I look at what the Fed is doing and the data as it's unfolding, I mean, all it really feels like they're doing right now is just taking the last few months of data and just extrapolating that forward. And things can change. And I think that's especially true of the inflation data. And, I don't think you can really make a fundamental story for why inflation perked up. I mean, you can point to specific things here and there, right? Auto insurance, people talk about healthcare services. But generally speaking, it really boils down, in my mind, to what's going on with the labor markets. And the labor markets are cooling. I mean, I don't think that that's even a debatable point. If you look at average hourly earnings for all employees over the last 3 months, it's up less than 3% at an annual rate. So if you believe that inflation's going to remain sticky, John, you need to start worrying then about a decline in real wages. And if real wages are contracting, then consumer spending will slow. And if consumer spending will slow, corporate earnings will slow. So, I don't think that strong. I mean, in the first quarter, you had this strong inflation data. And I think a lot of investors sort of thought, okay, this is reinforcing this inflationary boom narrative. But the labor markets, frankly, just are not in the same place as they were a year ago. And unit labor costs are basically 1%. So I just wonder where the inflation comes from. So my sense is that if you want to be optimistic on the economy, you almost have to think that inflation slows down. Because if it doesn't, then you need to start raising your recession probabilities.
Going into the pandemic, the Federal Reserve used to say things like, we need to extend the cycle. And some of the language, I remember a phrase, I think it was Vice Chair Clara at the time, would say things like, an ounce of protection was worth a pound of cure. Are you saying they should move preemptively and begin to reduce interest rates just on the margin, surgically?
Well, I think that's all we should really expect. I mean, I've been saying that they should be recalibrating policy. But I think that they should be focusing on what's happening with the labor markets. And the labor markets are clearly moderating. And so you're basically saying, we're waiting on like healthcare services inflation to moderate and some of these idiosyncratic factors. I mean, again, to me, it's, and in many cases, economics is basically like an identity. Things on one side of the equation have to equal things on the other side of the equation. And certain things just need to be true. And so from my perspective, I mean, compensation growth should equal inflation plus productivity. And what do we know about those things? We know that compensation growth has been slowing, right? No matter what you look at, and all, labor turnover is down. The number of people that haven't seen a movement in their wages over the last year, that number's up. If you look at quits, hires, those have all moderated. If you look at posted wage growth, that's moderating. So we have a pretty good indication that wage growth is slowing. If you look at across a whole number of industries, whether that's professional and business services, retail trade, leisure and hospitality, wage growth in those industries, particularly leisure and hospitality and retail trade, because those are the folks with the higher propensity to spend. Those industries are seeing wage growth at the low end of their range over the last year. So if compensation growth is moderating and productivity is normalized, you don't really get much. I don't think you can really make a very strong case for inflation, other than, it's been strong. Well,
Tony, I'd love you to weigh in on this. You believe that the disinflation story is true, and you expect it to continue. But we're talking here in nuance, because at a certain point, if it stays sticky at a certain rate, it can still lead to some real problems. So can you give us a sense of what the trajectory is and kind of where the margin of error is for the Fed at this point?
Sure. So, I mean, we kind of agree with the idea that, the labor market is softening, and we think that's going to kind of flow through to wage pressures declining as we go through the year. Our view is that while inflation is going to continue to decline, it's going to do it really slowly. So it really was rapid in the second half of last year. We saw this spike kind of early in the year. That was really a surprise to us, I think, and the market, that inflation was so hot. Our view is that we're sitting at maybe a 2.7 kind of PC level by the end of the year, so kind of flat to where we are now, maybe down a tenth. Next year, we again move very slowly towards more like a 2.3, and getting back to the target is more of a 2026 event. So in that environment, it allows the Fed to us be basically higher for longer because the economy remains pretty resilient. While we're seeing that softening in the labor market, it's not down to sub 100,000 jobs. It's more to the 100, 150 range rather than what had been a 250 range. So still reasonably healthy macro environment.
What does higher for longer mean at a time where you've got Tom Sisouris and Adam Posen saying basically a Fed rate cut here would be a policy error because of some of the inflation it could fuel later on?
Yeah, so our view is that right now we have a real rate that's well over 2%. We think that one cut, maybe two by the end of the year is the most that we'll see. That kind of recalibration to us is not going to drive a spike up again in inflation. It's just going to keep the real rate at a level that is not overly restrictive and therefore putting the labor market at greater risk than is necessary given the current overall environment.
Can we talk about what everyone's been talking about over the last several months, which is the supply side story? Neil, I know you've got thoughts on this. Alan Zentner of Morgan Stanley has made the point that this economy can get bigger without getting tighter. And what everyone's pointing to is the amount of immigration we've seen in this country. Do you think we're putting too much weight on that explanation as to what is developing in the labour market?
I mean, this is a very hot button issue, John, but I do. I think that, America's not the only place in the world that's seen rising population growth. Just look to our friends in the north in Canada. They've had very rapid immigration growth. Hasn't stopped their economy from not doing well. If you look at per capita GDP in Canada, it's in the toilet. So just because you have a lot of immigration doesn't necessarily mean that your economy's strong. So I really think the immigration angle is something that people are looking at as a way to work back. Lots of places across G10 have seen very rapid growth in immigration. What's not clear across all those countries is strong growth. The U.S., in that respect, is the one that stands out, which would suggest that productivity in the U.S. is the primary reason of why we've seen this outperformance.
Can I just ask, Neil, though, a lot of people are saying it's not just strong growth. It's that the growth came without the inflation as a result of wages climbing as much as people previously expected. That was the component of immigration that people were talking about. Do you buy that?
I don't follow.
That basically because immigrants were coming to this country willing to work, even for wages that were lower or potentially, that it actually kept down some of the wage inflation that otherwise would have been given the natural tightness in the labor market.
I'm sure you could find some. You have seen some slowing in wages, so maybe, you can make more of a labor market case. But generally speaking, I think there are lots of other reasons beyond immigration that, for example, we're less exposed to what's going on in Ukraine and Russia than Europe, obviously. Monetary policy transmits itself differently in the U.S. because we have so many people on 30-year fixed-rate mortgage debt. That's not the case in Europe. We had a very, very robust fiscal response relative to Europe. And, generally speaking, the U.S. does set, in my mind, the productivity frontier for the world. So we're sort of on the leading edge of that. So there are lots of reasons for why the U.S. has outperformed. I think immigration, frankly, ranks very low on the list. I think that's shown in the fact that lots of countries across G10 have seen very strong growth in immigration. Not every country's been enjoying the kind of economic performance the U.S. has enjoyed.
Tony?
Yeah, so our view is that the immigration was just very well timed. It's not a long-run fundamental force. It's going to be a driver of growth and higher potential growth for the U.S. over the next 5 years, given immigration policy that in this country is challenging. But the timing of it, which was above expectations, really helped ease some of those pressures on wages. But going forward, it's going to have to be much more about labor force participation to help grow potential growth, or productivity remaining very high, which is possible with AI, but it's going to be more of a traditional either productivity or labor force participation. That second one there is probably unlikely. So it's going to have to rely on productivity in our mind.
Well, that's a great point that it could be temporary, right? A lot of the immigration that we're seeing could just be pent-up demand from the pandemic. The visa approvals were basically shut down, and then we reopened them. So, and now you have a lot of foreign-born workers coming into the workforce. But that shouldn't sustain. I do think it's interesting that you've started to see the foreign-born workforce moderate a bit at a time when everyone's talking about it. Kind of makes me think about what it means that everyone's talking about not being long duration and thinking rates are going to be 5%, like what that means for the next move.
But that's I think, exactly where I was going to go, Tony, this idea that people are saying that the reverse could happen, where suddenly you get an immigration policy that would restrict some of the foreign workers, and that would lead to a surge in inflation. Do you not buy that there could potentially be some sort of post-election increase in inflation expectations that could really challenge the bond market?
I think it'd probably be more likely to come, election-related, be more likely to come from maybe potential tax changes that occurred. What happens with those tax changes are going to either roll off or not, than necessarily immigration policy. Immigration policy might take, I think, a little longer to work through, and we already have a labor market that's softening, as Neil pointed out. There's lots of metrics that we look at that say it's softening. So I don't think it'll be from the labor side that we might get that inflationary impulse that's election-related.
Would you expect to see this in payrolls next Friday, that deceleration continue?
Yeah, we would say that we're probably likely to see a 200 or below number rather than move back to 250. So it's not a weak labor market. It's just one that's not overheated like we were.
Final word, Neil. Yeah, I would just say, I mean, Lisa, you mentioned immigration's taking the pressure off of wages. I mean, let's be clear. Excess labor demand has been slowing very rapidly as proxied by job openings. So it's not just, we have all this supply. I mean, demand has come down. Businesses are trying to get the most out of their workers. They're not really trying to go out and hire more workers. And I think that's very important because that's what's keeping unit labor costs in check, which will in turn, in my opinion, bring inflation down.
Interesting. Payrolls 2 Fridays away. The estimate in our survey at the moment, a sneak peek for you, 180K. The previous number, 175. Neil Dutta of Renmac, Tony Rodriguez and Nuveen. Gents, thank you. And Michael McKee as well. Thank you, sir. Let's get an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Starting with some deal news. U.S. pharmaceutical group Merck is reportedly buying iBio. It's an eye drug startup. The FTC says that the deal will come in the form of a $1.3 billion upfront payment and then a further $1.7 billion payment depending on certain milestones. They cite an interview with the iBio CEO. Merck, for its part, declined to comment. Chinese car maker BYD unveiled a new hybrid powertrain that's capable of going 1,250 miles without a recharge or refuel. To put that in context, that's the equivalent of driving from New York to Miami. In a live stream event, the automaker announced that it will use the new tech in 2 sedan models that will cost under $13,800. For now, made in China cars will likely get the upgrades, but they'll likely to be exported soon. Elon Musk's XAI startup has locked in another investment. Cathie Wood's ARK Venture Fund purchased a stake in the nascent AI startup. The stake is about 2% of the fund's holdings now, and the purchase comes a month after the fund disclosed a position in OpenAI that made up roughly 4% of its holdings. ARK's chief futurist said that after the purchase, that AI foundation models are going to be worth trillions of dollars by the end of this decade. And that's your Bloomberg Brief. John.
Danny, thank you. Great work today, as always. Appreciate it. Equities right now down about 0.75% on the S&P 500. The opening bell about 40 minutes away. Up next on the programme, we're setting you up for the day ahead. You're watching Bloomberg Surveillance. Live from New York, counting you down to the opening bell. Here's the trading diary, setting you up for the day ahead. This is who we'll hear from at the Federal Reserve. Presidents Bostic and Williams a little bit later on today at 1 p.m. Eastern Time. Bramo's main event. She's staying in the office late for it. If you've got a Bloomberg terminal, there'll be a green dot next to her name at 1 p.m. Eastern Time. The US selling $44 billion of 7-year notes a little bit later. Won't be leaving. If you want to drop by the studio and have a chat to Bramo.
All right.
She's going to be here for the next 5 hours. And then she's sticking around for the beige book at 2 p.m. for more of the same. Lisa, some big events a little bit later this afternoon.
Well, I mean, look, let's not overblow the beige book. I mean, I tried to make it sound exciting, and Michael McKee was like, no, it's basically exactly what we've already heard. I do think the 7-year auction could be interesting, just based on the weakness we've seen with the other 2 auctions, as well as the Fed speak. How much are they adjusting their viewpoint around this table? I just want to reset. Around this table, we have heard people say that there could be a potential policy error if the Fed goes now in terms of cutting rates, and people saying there's a policy error if the Fed waits too long. Either way, the window's narrowed. Does the Fed feel that way, or do they feel less pressure and that the window is still long and ample for them to make a decision?
I think it's fair to say this market has moved way more this year than Fed officials have. I think that's fair to say, right?
I think that's well framed,
Okay,
yes.
If you wanted to take the temperature of this market at the moment, I've got a story for you. Have you seen this in the New York Post? On our good friend Dan Ives of Wedbush. I'm Wall Street's best dressed man. Here's how I use fashion to help me navigate a stressful, high-stakes job. Have you seen this article?
I have not.
And it's just a series of pictures of Dan wearing fashionable clothes, including a photo of his appearance in the last week on this programme, wearing shades and that green jacket after NVIDIA results.
Fashionable clothes, is that how they framed it?
I literally got a message just moments ago and someone said, I'm just going to say this is a sign of the top. That's what they have to say.
Look, I love him because he has his own style. He has them sort of custom made in different places that he goes around the world, and he finds these patterns and these sort of other patterns that he puts on top of those patterns that are all bright colors. I love the idea that, you know, if there is ever a disappointing earnings season from one of the tech giants, that he will come in.
He's promised.
He's promised, dressed like, you know,
I'll give a final word on this. If you're looking for Dan Ives and his clothing to give you a sign of the top, Dan's been wearing the same thing the whole way up. Like the whole way up. Like 200 percentage points ago on NVIDIA, up. Like, it wouldn't have told you anything. I want to finish on this. That story out of BYD, that hybrid, 2,000 kilometre range at $13,800. It's a big deal. It's a really big deal.
It raises questions about priorities.
Big questions. Coming up tomorrow, your lineup: Peter Oppenheimer of Goldman, Baker Hughes CEO, Lorenzo Simonelli, Siva Shah of Principal Asset Management, and Deutsche Bank's Biggie Charter.
Welcome to a special Roland Garros update for Bloomberg TV and Radio from Tennis Channel. I'm Andrew Guy. Arina Sabalenka blasted her way into the second round with a dominant straight sets victory over Erica Andreeva. The two-time and reigning Australian Open champion raced to an early lead after taking the opening set 6-1. And once in front, she didn't look back, closing out the victory 6-2. And don't forget, you can watch all the action from Paris live on Tennis Channel. It all starts at 5 a.m. Eastern.